The problem's going to be is when people realize, wait a minute, look at these inflation numbers. They're coming back up instead of going down.
Inflation's likely going to be higher than it was in the last cycle.
What you're hearing from Fed officials is very much in line with what the data are showing, which is they're starting to get a little frustrated.
We're still pricing the Fed cutting before anyone else, and that bit I don't understand.
If I were a forecaster still, I am pretty sure I will put in a small recession later this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Closing out the month of May, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market just about negative on the S&P, negative 0.2%, but just monster outperformance year to date and over the last month on the NASDAQ 100 relative to pretty much everything else, Tom, including the equal weight S&P.
Still a story today, and I know it's led by Nvidia, and we've all decided that we don't own Nvidia, so that we had a lousy May, but the answer is it is about a NASDAQ that's outperformed, but the backdrop is fascinating when you look at the economics. Maria Tadeo talking about inflation in France coming in lower, Spain coming in lower, and the news from China today, John, is underreported against that NASDAQ boom.
PMIs last night dropped from China, manufacturing PMI deeply below 50 now. Unsettling for those who are looking for a big rebound in the economy off the back of reopening and bang, the euro breaks lower. The euro now 106.76. Bramo, that's the one we've been watching, just this drip feed of negative information pushing back against this consensus view that this is where the growth would be. China, this is who would benefit. Europe, and things are starting to roll over.
And it's been so hard to understand the international impulse of some kind of China slowdown, given the fact that it's unclear how much was domestic and how much was internationally driven in terms of consumption. At this point, the big question for me, given the downside surprise after downside surprise in China, when do they start stimulus again? Do they?
Exactly.
And does it actually matter for global growth? Does that matter for international consumption, or does it continue to be a domestically driven game?
My reading of this, and Duncan Wrigley was absolutely fabulous with Ian Shepardson at Pantheon on this morning, is, boy, Lisa, they got to act fast. This is not going to be something. I would look, John, frankly, Sunday evening, our time, 7 p.m., boom.
But this is why it's so hard to get conviction right now. And this is the reason why people are basically piling into a couple of AI names and continuing to stay defensive. I like what Mike Wilson said when he was on with you guys, saying basically this is a defensive market. Of course I did. What do you think I do?
Very cool.
Obviously. Everyone watches.
It's so sad. That is so sad, Brad.
Oh, thanks.
Isn't
Love
that
you
sad?
too. Glad to be back.
Isn't that sad? Not just Nvidia, though, by the way. Meta, AMD, Salesforce, Tesla. And just on Tesla, I read a fantastic piece yesterday.
Please.
Best thing I've read all year. It's all about Fidelity cutting the valuation of Twitter. But the last line of the story should have been the first line, because the last line of the story was this. Despite Twitter's issues, Musk's wealth is up more than $48 billion this year. So here we are throwing mud at Musk because he paid $44 billion for something that's worth nowhere near. And year to date, his wealth is up more than 50. Now, this is all like paper stuff. I get it. But it's so funny to me to see the last line of a story, which, Lisa, probably should have been the first line of the story.
It probably underscores the schadenfreude that people feel and the reason why everyone's rooting for things to, potentially go after him. Because if he were really getting kicked in the head, then perhaps people would be like, all right, maybe it's enough.
He's doing okay.
Exactly.
I think he's doing okay. Better than okay. Your equity market on the S&P 500, negative 0.2%, bit softer there. But this month, this year, I'll swear on the NASDAQ, we've been absolutely flying. In the bond market, yields come back down by 3 or 4 basis points, the 10-year 364. And there's the move in the euro, back down to a 106 handle. Tom, 106.72.
Oil, 68.19 on American oil, and it hasn't found a bottom yet. I mean, it's south. You're going to get a 67 print here at some point, and this is this global slowdown. I looked at London copper, the Bloomberg Commodity Indexes, all rose back to China, which has got to be the theme today.
Lisa, the PMI's coming in softer.
Yeah, and this is going to be a theme going forward in order to understand just how much disinflation really takes hold. We haven't mentioned the debt ceiling and the debt limit, which I'm very happy to hear about, frankly. It's probably part of the reason why I took time off. I figured nothing would get established. It has. The House is voting on that debt limit deal that they did strike. Very curious to see the breakdown and how much of a pushback there really is from the Freedom Caucus. Also, Ron DeSantis coming out really against this. How much does this really factor into the presidential election? Today, jolts data comes out at 10 a.m. I also came back for the Beige Book, which comes out at 2 p.m. Really curious to see job openings in particular. I want to know how much we continue to see some sort of deceleration there. And just in case you're worried, I also came back for the Fed Speak. It includes Boston Fed President Susan Collins, Fed Governor Michelle Bowman, Philly Fed President Patrick Harker, and Fed Governor Philip Jefferson. Very curious to see whether there's any cohesive. Yeah. God, just such kindness.
Waiting for that. Once that debt ceiling deal passes, Tom, you'll have tons of issues.
Yeah, I read Jersey with a couple memos on this at Bloomberg Intelligence.
Hundreds of billions.
I didn't understand the memos, but there's a lot of money coming in short-term paper, and you see it in 3-month 10-year. Lisa, this is your world. The short paper versus the benchmark, 181 basis points, right down near that 191.
Who gets excited to come back for Fed Speak? Steve Chevron, head of US multi-asset solutions at Federated Hermes, joins us right now. Steve, we talked about the outperformance of the Nasdaq, and good morning to you, sir. Any reason to believe that ends anytime soon?
No, I mean, I think you do have another sense of American exceptionalism that's taking hold. I think if there's been a surprise this year, I mean, AI, look, that was something that I can't say you necessarily knew it was coming in the way or as fast as it's come, but that's something that you can understand. But there's also been this flight to quality trade that's helped growth stocks. And we knew that happened in the pandemic because we were locked in our homes. And, I like to say it was so bad I even had to watch an episode of Bridgerton, which is the worst thing I've ever had to do.
Oh, but, come on. I like Bridgerton.
Honestly, I'm with him. Probably one of the worst things he'd ever have to do. I agree.
I totally disagree. And we can talk about that in a little bit, but carry on.
He looks like the guy in Succession.
Well, which one, Tom?
Carry on, Steve.
So on the other side of it, though, you had this scenario where under bank stress, companies with these fortress balance sheets got a bid again. And that, I think, has been a little bit of a surprise this year that's driven at least high-quality tech to being that defensive trade again. We understood why in the pandemic. I'd say we were probably a little surprised that they reasserted themselves as a defensive trade in the wake of the bank stress, but they have. And here we are again with American exceptionalism in the equity markets.
So here's really the conundrum that I feel in the angst of some of the notes that I've been getting. Mm-hmm. Could you end up with basically a range-bound S&P, but the conservative trade, the defensive trade, getting upended with some of those names rallying as big tech perhaps loses some steam? Basically, a lot of churn underneath the hood, just slamming everybody out of their positions.
Yeah, Lisa, let me start here by saying if you have super high conviction right now, you're not paying attention. This has been a very slow moving economy and market. I think what we believe is that we are headed towards slower growth. I think you're seeing that in Europe now. You're seeing that in China. It's the collective impact of rate hikes. It's inverted yield curves. It's negative LEIs. It's all of that. The question is it a continuation of this rolling recession rocky landing that we've been on that keeps you in this kind of range-bound environment, or does it break into a classic recession? I think that's still very much the open question, and we don't know the answer. And so the answer to your question depends on that. If it's this kind of rolling recession, then yeah, you could see kind of growth continue to lead the way. You could see bond yields kind of range-bound. Spreads don't really widen. The Fed doesn't cut all that much or anytime soon. And you're getting your 5% in cash and your growth stocks, and those are the only games in town. If it breaks into a classic recession, now all of a sudden bond yields fall. You've got a bond trade, credit spreads widen, which open you up to a kind of positive credit trade down the road, and you're probably going to see more broader pressure on the equity market. That's why we're watching these small banks and small businesses, because however that breaks is going to tell you which direction you're going in.
What's the message from commodities right now?
Well, commodities are telling you that global growth is slowing, and that I think if you look at what the commodity market's telling you, it's either meaningful disinflation on the horizon or outright recession risk. And if you look at some of the numbers coming out of China and out of Europe, I think you're starting to see those economies break towards that more classic recession. In the U.S., it's taking longer, and the economy has been more resilient. The 30-year fixed rate helps. There was more excess savings. There was more excess stimulus in the U.S., and so we may be headed on that path. That's not clear yet, but it certainly isn't happening as quickly as it is in the rest of the world.
Steve, and beyond that, the stock market is not the economy. There's a key line that you used, the key phrase, and I've been trying to drill into this over the last week, so I'm pleased you went there on your own. American exceptionalism in the equity market. Steve, we had a decade of that. Europe, Euro Stoxx 50 didn't have the FANG names. And right now, Europe doesn't have Nvidia. Now, Steve, I just wonder, are we setting up for the same thing again, or is it still far too premature to tell?
Well, I think you are, at least over the medium to long term. And John, if you really want to break down economic growth, it's two things in the long run. It's how many babies do you have or bring in, and how much can you innovate? And when you look at the U.S. demographically over the long run, you've got 10, 20, 30% working age population declines over the next 30, 40 years set for Europe and China and Japan. The U.S. doesn't have that. The U.S. has 9, 10% population growth projections in the working age cohort over the next 20, 30 years. And you're the center of innovation, right? Whether it's AI or robotics or the Internet of Things or blockchain, you name it. It's really starting with U.S. intellectual capital. So if you're taking a long-term bet on which economy is going to lead the world and which stock market is going to be rewarded for that, it's absolutely the United States. It is the only major economy that has the combination of robust working age population growth and that kind of transformative innovation. And I don't think that changes anytime soon.
Well, we're going back to the start of the conversation then. Equal weight S&P, market cap S&P, NASDAQ 100. Steve, if you had to own an index right now, what would it be?
Well, I think you're barbelling on the equity side. I think, one, you want to own those defensive dividend-paying stocks. I think the idea that the economy is not going to slow in the face of 525 basis points of rate hikes and probably, at least 25 basis points more to come at some point, I think that's a low probability bet. And those defensive dividend payers, the Dow Jones Select Dividend, if you will, I think is a good place to be. And then you got to pick some cyclical part. Markets rally on Fed pauses, even if a recession is to follow. So then you ask yourself, well, what's that risk asset that you want to own? It's not cyclicals. It has been international for us. I'd like it to be growth going forward, but I'm not going to pay these multiples. So I think the story here is you buy growth on any meaningful pullback, you sell cyclicals on any meaningful rally, you don't chase.
Hey, Steve. Good to catch up. Steve Chevrone of Federated Hermes. Okay. Big line that, TK. You and I started that conversation last week. Is U.S. exceptionalism making a comeback?
Yeah.
With Nvidia mounting higher?
Voya's leading the way on this, and there's others as well. This huge deal. I can't wait to see the mathematics of active versus passive June 30th.
Equity slightly negative. We're down 0.3% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through House Rules Committee by a 7-6 margin. The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. Meanwhile, U.S. House Speaker Kevin McCarthy has dismissed threats from Republican hardliners to remove him from his job. Foreign ministers of the North Atlantic Treaty Organization countries began a 2-day meeting in Oslo while they discussed Ukraine's bid to join the military alliance, as well as how to boost defense spending. French President Emmanuel Macron will also speak. He's expected to emphasize the importance of NATO's role in Europe. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I'm not sure what in the bill people are concerned about. It is the largest savings of $2.1 trillion we've ever had. These are major victories. I understand people get upset about walking through a debt ceiling. but this is a House, a Senate, and a presidency.
We're going to make sure that the country does not default, but we also are going to make sure that Kevin McCarthy and my colleagues on the other side of the aisle, of course, uphold their end of the bargain, which is simply to produce a sufficient number of votes.
House Speaker Kevin McCarthy, House Minority Leader Hakeem Jeffries speaking on Bloomberg's Balance of Power just yesterday. Wall Street hoping we can just move on, and hopefully we can. We could have a vote a little bit later in the House as Tom, things pass a key procedural hurdle yesterday evening.
We've got to mention what you brought up last time, and I'm not read in on it. I'm sorry, but there's going to be a balloon and T-bill issuance at some point. I mean,
Once this passes,
there is a ramification of this silliness in Washington to our world.
Which will be hundreds of billions of dollars of T-bills. There are some people who think that will be totally okay. There are some people who think it can exacerbate existing tensions, which are in the banking sector, competing for capital with banks, Bramo. I can imagine you're thinking about the other side of the trade just a little bit more. But we had someone from Columbia Threadneedle, Ed Al-Husseini, sit on the other side of the table with us yesterday, Bramo, who thinks that this will be okay. We'll get through it, no big deal.
Most people do, which is the reason why the distortions haven't gotten exacerbated in the T-bill market. But if you think about the banking stress, you already have seen some of the biggest capital flight from the deposit accounts in 50 years. What will this do to that?
Yeah, and am I right that this Friday maybe is when the report comes out, we may see further deposit flight? Why wouldn't we? You know, I just wonder the flows are in place. It may
it's
not
something
be as
we're
large.
watching. I'm not going to make the call. Loretta Mester in the FT, I think, is worth a read. Cleveland Fed president
What'd she
talking
say?
about making another move next month. She doesn't see the conditions here for a pause, looking for a hike in June. Still got payrolls on Friday, CPI the day before the next Fed meeting, and we'll see what we get. We talked about Andrew Hollenhorst recently of Citi, who set the bar incredibly low, I think, for another move at the Federal Reserve. 200K on payrolls. He says 0.4% core month on month CPI. Gets it done for him, 25, still to come.
We'll give you the coverage on Friday. We go beneath the headline data at 8:30 in the morning. Right now, we speak expertise with Wendy Schiller, Director of Taubman Center at Brown University, one of our most popular guests. We get huge response when Professor Schiller is on. Professor, there's that scene in the movie Lincoln, Daniel Day-Lewis and Sally Field, and Tommy Lee Jones steals it as Thaddeus Stevens. And there's all the drama of the Emancipation Proclamation and all that. Really, history repeats itself. It seems like that right now. Who's the Thaddeus Stevens right now in the Hill that's going to get this done?
Well, I mean, I think that the Democrats, essentially, Hakeem Jeffries, is going to have to deliver. And he keeps saying, oh, well, we need 150 Republican votes. We're going to hold off. But in the end of the day, the White House has a Democratic Party occupant. And you have to save the president, you have to save the economy. So the Democrats, and basically led by Hakeem Jeffries, will have to step in if the revolt, quote unquote, that we're hearing about among Republicans grows much larger between now and the time of the vote today.
Mr. Manchin got a pipeline. He's over in the Senate. What are they going to give House liberals to get their vote?
Well, they're not going to need that many liberals. They're not going to need the most left wing of the caucus, progressive caucus. They may or may not sort of give them a pass and say, you know, you don't have to go down this road, because the most left wing will say, well, the most right wing is not voting for this bill. Why should we vote for the bill? So that's the defection concern, right? The snowball effect is if you give some people a pass not to vote for this bill, how many more people do you have to give a pass not to vote for this bill? And then does your majority collapse? I don't see that happening. I think there are enough confirmed Republicans, maybe not 150, but enough that Hakeem Jeffries will only have to get a certain percentage of his Democratic caucus. And those moderate Democrats, are not that many left, but the moderate Democrats are going to need to vote for this just to show that they're willing to do something to contain the federal deficit.
Wendy, what does a West Virginia natural gas pipeline and the accreditation of it have to do with fiscal responsibility?
Well, it's about the way that we do our budgeting. It's the fact that we have a Congress that is geographically apportioned and is bicameral, right? Think about that. You have very different incentives for senators versus House members, particularly smaller population, sort of larger geography states that have natural resources. I mean, this is the institutional structure that was created a long time ago. It doesn't quite fit. It doesn't really fit at all our major, huge federal budget and federal government, but we're stuck with it. And these are the kinds of trades you need to get things done. What I'm shocked at is as much policy is being made in the debt ceiling. I can go way back to Graham Rudman, and that was attached to the debt ceiling, but that was budgetary policy, and it made sort of sense then in the 80s. These are all sorts of policies, social welfare, energy, climate policy attached to a debt ceiling bill is not the way you want to make policy for a government this large.
Which is the reason why Bloomberg Intelligence came out and basically said, yeah, it might reduce the deficit by a little bit of a rounding error, but longer term it will slow growth by even more, and it doesn't actually address some of the real pressing fiscal concerns with respect to certain programs that are going to be unsustainable. What's your view on that? I mean, basically, is this lipstick on a pig?
Well, Lisa, I don't know if I go that far. But I think what most people have to understand is that at least 2/3 of the federal budget, which is probably going to push over $7 trillion, we're at 6.5 now, that is entitlements or built-in spending, defense spending, programs that you cannot touch that are facing some insolvency concerns, Social Security, Medicare. Those programs are just, nobody touches them. Congress won't go near them. I mean, they're doing a few things to sort of trim the work requirements, in other words, make it a little bit stiffer to get some social welfare programs, but the big ticket ones are not being touched. And until those are touched, the federal budget will continue on this growth trajectory, which means we're going to be spending more than we take in every year. And the debt will just keep growing, particularly if you cut the IRS, the Internal Revenue Service, which collects revenue, which helps balance out our federal spending.
Professor Schiller, you mentioned Graham Rudman. Just simply, Civics 101. Why can't we get a commission done that has some strength to get to a good resolution?
Because I think the Republican Party has sort of strategically decided that being anti-federal government across the board is winning them votes and keeping their base roiled up. And that's partly federal spending. You have some states now with Republican governors that are saying we're not going to take federal money. We don't want the strings attached. So going way beyond unfunded mandates, they're now saying we just don't want the money and we're not going to do provide the services that the money would help us provide. So you're seeing a larger trend, a deeper trend in the Republican Party that is rejecting federal authority. And this is part of it. And so if you can cut spending and that becomes a big ticket item, and you want credit for that, you want Congress to do that, you want to be in a room saying you have to cut spending because that gives them a talking point that's resonating quite well among their base at home.
Wendy, forgive me for asking for a time frame, but for how much longer do you think Speaker McCarthy is Speaker McCarthy?
Well, Democrats have come out and said they're going to keep this guy afloat, right? They've already said if his own party rejects him, we will find the votes to keep him. Because, of course, the alternative could be significantly worse for the Democrats and for President Biden. So McCarthy looks like a guy, when push comes to shove, will get the most basic things done. And he seems to have grown into that role. And if he gets challenged, I see some Democrats, maybe those who are going to retire perhaps in 2024, but they're going to come to his rescue, which they've already said publicly.
Hardly a ringing endorsement for the modern Republican Party, is it? Kevin McCarthy needs the support of Democrats to remain Speaker McCarthy.
Well, that was the way Boehner was as well. Yeah.
Yeah, right. But John, this is also, but Democrats should be aware, or independents should be aware, because these splits in the Republican Party are what we also saw, as you just mentioned, about John Boehner and Paul Ryan. And yet Donald Trump won with a big, huge surge of Republicans in 2016. So I don't think it tells you anything about the potential for the Republicans to unify behind their candidate in 2024.
Oh, absolutely. That's not what I was implying at all, just to be very clear. Wendy Schiller at Brown University. Wendy, thank you. I meant for Kevin McCarthy. It's hardly a ringing endorsement from the modern Republican Party for him. The fact that he needs to rely on Democrats to remain Speaker McCarthy.
I can't state how Ronald Reagan invented you run on the outside and move to the middle through the election. And that method is dead. It's just gone.
I'm not sure if pride has been a big concern of his. He basically, how many votes did it take?
Was it 15?
15. So, I mean, he's just
like
willing
that.
to take it. That's not exactly, he's not looking for a ringing endorsement.
Bill Leah Milken, up next. Equities on the S&P 500, just a little lighter, softer, negative on the S&P this morning. Here's a picture of things for you. Down we go by 0.3% on the Nasdaq 100 on a 3-day winning streak. Could break that today. We're down just a little bit, slightly negative, down 0.3% there as well. Month to date, though, the Nasdaq 100 up by more than 8% this month. Up more than 8% with the equal weight S&P 500 down 3% this month. That's 13 points of outperformance. Month to date. It's kind of crazy. Even with this in the bond market as well. So let's look at bonds together. 2s, 10s, 30s. 2-year before today on the month, higher by 44 basis points, trimming some of that down a couple of basis points to 442. But remarkable, Tom, to see those gains in the equity market, in the NASDAQ, in big cap tech, with those moves in the bond market at the same time.
Quickly, curve inversion. We had negative 80 basis points yesterday, still negative 78, substantial, as you say, John. Over the month, we've seen a steeper, a re-inversion, not up to highs. Real yield 142, 10-year real yield. Maybe not all that much newsmaking, but I'm going to go to the 3-month 10-year. The T-bill, as compared, high-yield T-bill, as compared to the economic slowdown 10-year yield, 181 basis points. Is a wow statistic.
For a moment, this was boring, and then it got really, really interesting, particularly in the FX market. You had that lift in yields. You pushed that through foreign exchange. You got a stronger dollar. Got a weaker euro off the back of weaker China data. You got that again overnight. PMI's disappointing. Manufacturing a whole lot softer. Worldwide, actually, but led by what's developing in China relative to expectations for a big boom. The euro hasn't seen 108 for about a week now. Broke 107.
See 105
in the last 24 hours. I'm with you, Tom. I'm with you. 106.75 right now.
What we're going to do is what we do best. We are committed to international economics. Remember the IMF coverage that we did here in the recent weeks, including speaking to the managing director. It was April 6th. Our Eric Martin was reporting on the bombshell 5-year view of 3% global growth. I'm still not used to that report from the IMF. Thank you, Eric, for that report. And then today, Duncan Wrigley at Pantheon, Ian Shepherdson's Pantheon. Wrigley has to root for Newcastle with all that. He comes out and just simply says China to export disinflation and deflation. I think we saw that banner when Alan Greenspan was running the show. William Lee joins us now, chief economist at Milken Institute. Billy, let's start with Greenspanian 101. Is China in their slowdown going to export disinflation and deflation?
Well, China can't export much of anything right now, but I hope what they do is disinflation for the rest of the world. Right now, China's recovery has really faltered. We can see that not only is manufacturing down, but it looks like the consumption is on its way going to go down as well, with unemployment rates at 20% for youth unemployment. So China is not in good shape right now, and I think we are looking around and seeing what is going to pull China out of the doldrums.
What is the degrees of freedom an autocracy has Sunday afternoon, New York time, when they're supposed to provide stimulus?
It's pretty limited, right? Because not only is the federal debt out of control, the municipal level debt is out of control. So the general channels for fiscal policy have been through the municipal governments to try to hire more people, build more projects and stuff like that. Well, right now, they can't do that. So the amount of fiscal policy that we have is really limited. And monetary policy, I mean, you can lower rates, but people are just going to, stay there and not borrow because they're going to ask themselves, where am I going to spend the money in order to make money in the future if the demand is so slow? So China right now is snowballing into a fairly bad static plateau.
Static plateau that's been priced in or not, Bill?
I think one of the things that we have to look at is where is it being priced. One of the things we talked about at the Milken conference that just ended a month ago was that a lot of the investors going into China go into the private markets, and we really can't see a lot of that. But in order to get into the private markets, one thing that everyone made clear was they needed good Sherpas. They needed someone to guide them through to find good investment opportunities. And a lot of the investors claim they've got some good Sherpas there, and they're getting good bargains because the slowdown is affecting valuations both in public and private markets. But the real question to ask is, will you get the kind of returns you're hoping for? And there I have my doubts because the demographics are working against them. And on top of that, the possibility of technological change, which would be the one thing that boosts the Chinese economy, is also not going to be there because policy has been really anti-innovation, anti-technology, and it's hard to see that changing.
Which is, John, what you were pointing to when you were taking a look at the tech indexes over in China versus the tech indexes in the U.S. and that huge bifurcation between the two. Bill, that's maybe on a domestic level. What about internationally? Has this been priced in terms of the impulse that China had on Europe? We were talking about the euro and how much it's come off some of its earlier highs.
Well, the renminbi right now is weaker than it's been for God knows how long. And so in that sense, it's being priced in. But for me, the FX market is very short term. The real question is, are investors pricing in growth opportunities over the next 5 years? Are they putting the marginal dollar into China or are they putting it somewhere else? And I think more often than not, they're looking somewhere else.
Bill, you've got a great ability to move away from the Pacific Rim and the three cities we focus on all the time. What's the rest of China look like with the unemployment rates that are being reported?
That's a great question. Up until now, I would have said the prospects for any kind of innovation, any kind of employment growth are going to come out west, because the Milken study for the greatest performing cities in China landed on Chengdu as a small innovation hub. And we still stand by those numbers. But unfortunately, these numbers are getting dated. And right now, I'm not sure if even out west, the innovation hubs will be able to give the kind of employment that they hope for.
We've been here before. And the answer is Beijing always blinks and moves away from a totalitarian mindset, the autocracy of President Xi, and they move to some form of liberality and capitalism. You're saying that's not going to happen this time? See, he's pointing saying, on radio, you can't see that. Professor Lee is, I got to duck because the chalk's coming in.
Tom, President Xi's blinking is going to involve maybe a slightly different wrinkle. He's going to rely on nationalism, perhaps, some militarism, some expansion of hubris into the rest of Asia, because after all, he wants Asia to be the currency area for the China and for the renminbi. So I think these are the kind of places we should look for any kind of resuscitation of Chinese nationalism, which is they're going to try to instill pride in the Chinese people without giving them jobs. And that's going to be a cute trick.
Well, what does that mean in terms of international business? And I say this as JP Morgan has their conference and plays nice, albeit in a brilliantly diplomatic, pro-American, but also pro-China kind of speech by Jamie Dimon. How much can you really see a decoupling or a willingness to exacerbate that on the Chinese side in light of the economic challenges?
Well, Lisa, we have a love fest by U.S. CEOs going back to Tim Cook and now Elon Musk. And Jamie Dimon is very slick in being able to say, I'm a true American. I really am a patriot. So when you vote for me, remember that, even though I'm asking you to come to China and support my people. And I think going forward, we're going to see more of that, because the question is, the people who are in China have to maintain their business and really contain what they've gained. But the marginal dollar, the investors sitting here in the West thinking of going to China, what are they going to see? And I think they're going to see a lot of opportunities in ASEAN, in Korea, and in the Quad countries surrounding China, because that's where a lot of the innovative industries are moving to.
I want to end the conversation where we began, where you're talking about sort of a stagnant plateau. What is that stagnant plateau in China? What is that rate of growth that's going to be the new normal and going to drive demand for the luxury goods that have gotten bid up, for commodities that have surprised a lot of people to the downside this year?
Well, Lisa, the official number is a 5 handle for growth going forward. And I think you're going to see more likely a 3 handle than 5. So I think that's the kind of order of magnitude you're thinking of, because with population stagnant, any kind of massive productivity growth can't get them above 3.
For obvious reasons, Bill, market participants are going to be very interested in the next move on stimulus to get the PMI back above 50. As you know, that's not what the leader of the Chinese Communist Party is going to be focused on. They're going to be taking a multi-decade view. And, Bill, I'm far more interested in the kind of fiscal moves that they make to stimulate more investment in certain parts of the economy that are going to be highly competitive with the United States and Europe, particularly as the US retrenches and refuses in some parts to do business with the Chinese government. Now, Bill, what are you focused on with regards to that?
Well, absolutely. In fact, if you look at where the Chinese are meeting and where they're not meeting with Defense Secretary Austin, so they don't want to talk military, because we know what they're going to do there. It is not very powerful for the U.S. But I think the place that they're meeting with is Gina Raimondo, as Commerce Secretary. They're hoping to leverage some action on the tariffs. They're hoping to leverage some action on cutting the semiconductor restrictions, and their information blackout is going to leverage what our investors actually see. They're going to shape the story for global investors to be so wonderful that that investors can't resist coming. But in order to do the due diligence, the required information to do the due diligence is something that's being restricted as we speak by the Chinese government. And going forward, I don't see that lifting.
That last point is so important, Bill. Clarity, transparency. How do I know what the unemployment rate actually is in China? Measuring it is hard enough, but when we hear youth unemployment something like 20%, just how bad is it, Bill?
it is that bad or worse. And if it wasn't worse, we would hear more about informal data. But instead, we see companies like Wind being wound down by the government. We see due diligence companies like Bain being queried by the officials. So I think the Chinese are making it very clear, we're going to feed you the information you need, but it's from us.
Bill Lee of Milken. Hey, Bill, good to catch up, as always. It has been a tough year for the equity market over in China. Take the Hang Seng China Enterprises Index, okay? That is down by more than 20% from the peak. So we are in a bear market for some parts of Chinese equities, in fact, many parts. And you compare that to the NASDAQ this year, that wasn't meant to be the way this played out in 2023, Tom. It was meant to be very, very different through the equity market.
Off the COVID boom, 6%, but to model down to 3%, and I go back again to April 6th and the IMF bombshell. And I don't think anybody believes the IMF bombshell, but nevertheless, a tendency towards 3% global growth affects China more than any other nation.
How do you create a valuation for some tech prowess if you're basically forcing tech companies to break up, to reduce certain aspects of their company? I mean, how do you innovate in that? If Alibaba has to spin off their cloud computing because of political reasons and then try to understand that, how do you invest in certain things? So to your point, John, how do you create consistency that allows for some of the investments to compete, and especially without stimulus?
There was a story that we put out in the last week or so that you could see some rate cuts, that you could see some fiscal stimulus, but targeted specifically at high-end manufacturing. And that's what I think I'm getting at here. When you see those headlines, if they do cross, that's not going to be about getting PMIs above 50 again. That's something much, much more strategic than that.
We'll talk about this. This is not going away. It's very important, the impact of this on America.
Angelo Zeno of CFRA on Nvidia and the year-to-date boom for that hot stock. That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. Meanwhile, J.P. Morgan Chase Chief Executive Officer Jamie Dimon says he's optimistic about it.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. North Korea has confirmed that an effort to launch a military spy satellite into orbit failed earlier today. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. Now, the launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Goldman Sachs is said to be considering another round of job cuts as the deal-making business remains slow. Sources say the third round will affect less than 250 people and will include the firm's more senior employees. Earlier this year, it had eliminated about 3,200 positions, embarking on one of its biggest ever round of layoffs. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
How many times AI was mentioned during the earnings season, but it was some astronomical amount, and everyone is latching onto it. I think we need to be very cautious going forward. I just think there's so many unanswered questions. I don't think you put all your eggs in the AI basket, but you have to have exposure knowing that it's going to be part of the future.
You know when you get a briefing from PR right before a call as a CEO? You know what the briefing sounds like right now, don't you? Just say these two letters repeatedly and watch the stock in the pre-market or after hours just go higher. That's what it feels like with Nvidia and other names. What makes me laugh, though, beyond Nvidia, it's names that you wouldn't typically associate with this kind of stuff, Bramo, that it's just like, yeah, we've been doing this for ages. For ages, we've been embracing AI.
Doesn't this feel like what happened with cryptocurrencies and just in general what we saw with respect to blockchain? Basically, you had furniture operators mentioning blockchain and their stocks would surge. I mean, it's basically Nvidia coming out after hours. We've got more AI, and everyone's like, yay, good job.
Long Island iced tea, wasn't it that? They put blockchain on the name or something like that. The challenge back then was to try and draw a distinction between the frenzy, the things that were going too far, and the real innovation, the stuff that would still be with us today.
I will just say this. Last night, the kids were studying, and what they all do is they run their essays, their tests through a ChatGPT paradigm to see what grade they would get. And a lot of teachers are doing this now, too. And then they get a grade, and then they know whether they have to work more or not. I'm just telling you, this is being weaved into the sort of daily existence of so many people.
Are grading them based on that, too?
Well, that's what they're saying.
You're implying the teachers at home, this is how they're grading the work.
I have heard anecdotally this has happened. I mean, they are overworked. And, you know, if they've got a lot of students, they could just run it through ChatGPT and get a grade. They could write the essays with ChatGPT, grade the essays with ChatGPT, and, you know, we could all just
We ran
hit the park.
afterthoughts math scores through ChatGPT, and the computer started smoking.
What do we need them for? What do we need teachers for? Right?
No, but in all honesty, I asked them, is this a tool to substitute, or is this actually, you know, just to help, to actually make you better? All of them say to make you better. So I'm gonna remain ambitious.
I think
and optimistic.
Lisa, I think it's completely overwhelmed by how much education was lost through the pandemic, and we're still catching up across every decile of America. Here, futures -10. The VIX is solid for the last couple of days, 17.77. John, where's the euro? Are we at a 105 yet?
We're at 106.76. Well, that would a session 106.59.
If you're just waking up, there is a lot going on this morning. There's no question about that, including a complete breakdown in oil. There's no other way to put it. That's American oil, 67.69. We're going to get back to $2 a gallon gas. That'll keep Lisa's H2 in good stead. Right now, we're going to talk the talk of the moment, Nvidia, with Angelo Zeno, senior equity analyst at CFRA, who in a brilliant note has the courage to write what everybody's thinking, which is the only way you can justify this is to extend your timeline. Angelo, you go right out to 2024. And you say, look, with a 25% growth pop, you're buying a 40 multiple stock. Why don't you extrapolate out to 2025?
Yeah, I mean, listen, I think you can. I think there's, always danger with kind of extrapolating the numbers outright. But I will say this, we are believers in kind of the entire NVIDIA story, in kind of the AI story, the fact that kind of GPUs are going to increasingly represent a bigger percentage of CapEx dollars for these cloud companies. We do think over time, over the next 3 to 5 years, the compounded annual growth rate for GPUs, and specifically that of NVIDIA on the accelerator side of things in the cloud, can grow at an annualized pace of north of kind of 20 to 25%. And that can kind of get you to an EPS growth rate over time for NVIDIA, again, north of 20%. If you're a believer that, the top line for this company can continue to grow at a mid to high teens percentage pace.
Are there other NVIDIAs out there?
So we actually wrote a piece back in late March about kind of the biggest winners of kind of the generative AI boom within the semiconductor industry. And we kind of pointed to 4 names at that point in late March. And those 4 names were, one, of course, NVIDIA. AMD is another name, clearly a beneficiary in the GPU side of things over time as well. And then the other 2 names are more kind of network connectivity type names. And they were Marvell as well as Broadcom, a name that we think is highly underappreciated, a name that's going to report tomorrow night at the close.
I'm wondering what a tech company is right now, and which companies can actually take advantage of artificial intelligence and some of this technology. Very clear-cut AMD or Nvidia, but what about Meta? What about, just on a broader sense, other companies that could potentially gain from the productivity of investments in artificial intelligence? How do you value which companies will gain and which actually won't at all and potentially could even lose?
Yeah, listen, I think that's probably the most important question we get from investors right now. It's from a monetization perspective, who are going to be the biggest winners kind of from this AI boom? And that's really it's a tough question to answer. I'd say, to your point, kind of the easy answer right now is on the semiconductor side of things. It is on the infrastructure side of things, and kind of playing that. And that's clearly where the action has been here in recent weeks. Now, when you kind of look more forward-looking in nature, when we think about some of the larger cap name stocks, I'd say Microsoft clearly at the top of the list in our view. I mean, with Copilot out there, with the potential to kind of see significant pricing power on that side of things, we think the line of sight is highly visible, and one where over the next decade should be a clear winner in our view. Now, other names like an Alphabet as well as Meta, we think are going to be a little bit tougher calls. And that's why you don't see kind of the multiple to the extent where you see that of the Microsofts of the world. And a big reason for that is, are they going to really get the ROI potential, or are they going to give advertisers out there the ROI from this AI boom? We think there is some kind of positives out there, but I don't think it's as clear as potentially a name like Microsoft out there.
So you can be a believer in this story, and I think that anyone who sees the way that people are using ChatGPT-like artificial intelligence has to be something of a believer, if not at least a very open recipient of this information. But you do have some naysayers out there about the valuation, basically saying that the rally that you have seen so far, 31% in big tech stocks so far this year, is at risk of petering out. This according to Citi analysts, basically saying that positioning is just such that it's rife for profit taking. I mean, do you sort of play into that? Do you just sort of look past that? Do you think that anything like that will just be a buying opportunity? How are you playing sort of the tactical ride up that we've seen in prices that can't really continue at this pace?
Yeah, I mean, listen, in terms of the performance here, there is, we think, going to be some sort of AI fatigue here, potentially in the coming weeks, some sort of digestion that's probably going to be needed. Now, that said, we remain very big believers that the valuation actually is not as extended, I think, as many people out there think, especially as you kind of look out to a calendar 2024 basis for names like an Nvidia and others, where kind of they are within their 5 to 10 year historical ranges, especially when you start thinking about kind of the growth tied to a number of these names. I'd also point to names like a Microsoft and others, where, listen, at this point in time, I'd say kind of the risk to the downside on EPS estimates are probably very low, and there's probably upside potential to those estimates. So we kind of we want to be long on a lot of these names that are AI related. And I would say kind of you kind of want to have a basket of names. You don't want to put all your eggs in one basket, and you want to be buying kind of on any pullbacks. But listen, it's definitely gotten a bit hot to an extent, especially on the semi side of things. But the four names that we highlighted, we think continue to be the biggest winners and the names we want to buy on those pullbacks.
You want to be long. Some people feel like they have to be long. I was just going through the analyst recommendations. I love this. 49 buys, 8 holds, and one guy who couldn't care less about career risk with a sell. Now, Angelo, that's what I wanted to finish on. Do you sense the so-called career risk associated with this, given how quickly it's moving? Is there pressure that you have to be long?
I think that's a great point. I mean, listen, I think there's always risk of kind of, there's always risk on that side of things. But, we are fundamental by nature. And to us, the fundamentals are screaming buy right now. And for that reason, I think you continue to need to pound the table on these type of names. And I think especially on a name like Nvidia, when you kind of look at the multiples at about low 40s on a calendar 24 basis, and then you look at the growth tied to it 3 to 5 years from now, and you kind of look at how early we are, if you're a believer of kind of, let's say, autonomous vehicles and what have you, there is risk to potentially having a sell to be tactical in nature rather than kind of beating kind of the table on the longer term outlook on these areas. And I think that's what you need to do for investors out there right now.
Interesting. Angelo, always great to hear from you. Thank you. Angelo Zeno there of CFRA. TK, the pressure if you've missed out on this so far yet today must be huge.
It's going to be huge. And I think you mentioned this yesterday. The pressure into the end of year for people behind. Window dressing this year, record level, given the oddities.
Andrew Sliman of Morgan Stanley talking about that. Emily Rowland of John Hancock Investment coming up next.
The problem's going to be is when people realize, wait a minute, look at these inflation numbers, they're coming back up instead of going down.
Inflation's likely going to be higher than it was in the last cycle.
What you're hearing from Fed officials is very much in line with what the data are showing, which is they're starting to get a little frustrated.
We're still pricing the Fed cutting before anyone else, and that bit I don't understand.
If I were a forecaster still, I am pretty sure I will put in a small recession later this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative on the session. It is up big time on a month if you're looking at the Nasdaq. The S&P 500 doing okay as well. The equal weight. This has been the big distinction so far this month, so far year to date. Once you strip out the muscle of big tech, take away Nvidia, take away Meta, Tom, beneath the surface, there's a struggle there that you can't see. You can't see at the level of the Nasdaq 100 and elsewhere.
I would suggest like we've never seen before. I mean, the diversions here are amazing. Tomorrow we're going to have sell in May and go away statistics for you, June 1, but we're not going to do it today. But the answer is these are profound trends, and you listen to the Mr. Zeno we just spoke to at CFRA. These are trends that he suggests endures out 1 year, 2 years, 3 years.
Most people listening to this program right now hoping we don't talk about the debt ceiling story. That deal could go for a vote a little bit later today, and then we can move on, we hope.
But we had a good vote yesterday, right?
Payrolls on Friday, then on to CPI next month on June 13th, then on to the Federal Reserve. And if you're looking for some Fed speak this morning, in the Financial Times, Cleveland Fed President Loretta Mester teeing us up for what, Bramo? One more hike.
Right. And basically, she has been on the more hawkish side. But her talking about one more hike coheres with what we're seeing in markets, where there is this feeling growing that they could afford to go one more time. There has been a resilience. Consumers keep spending. Here's my key question heading into June. Are we at an inflection point? And this is what Oxford Economics had to say. Yes, we are. That all of the drivers of the first half of the year, whether it was China, whether it was some of the resilience that we see in consumer spending, are all set to roll over. If that's true, what happens to the indexes? They say range bound. I mean, again, this is sort of the conundrum of the economy on one side and markets on the other.
Well, you can see it in the weakness in European equities, in luxury this morning. You can see it in the underperformance in Chinese equities all year, for that matter. The reopening trade kind of really started in October and ended by the time we started 2023, just at the same time people were getting excited about it. But I'm with you. I think the breakdown in the European story is the one that's taken my attention in the last several weeks, Tom, in anticipation that maybe we'd have to push back against this idea that this is where you want to be, this is where the growth will be, this is where the equity market gains will be. More recently, that story has been challenged. And in the last hour, we heard from Steve Cheverone of Federated, and we heard that line that we've talked about a few times in the last couple of weeks. Are we going back to so-called US equity market exceptionalism? And the problem that a lot of people have listening to this is that they have a real struggle on their hands. In the US equity market right now, are we on the brink of a melt up or a meltdown? And if you ask people, they'll be split one way or the other. There is no conviction consensus out there on that.
The consensus has been some form of marginal move to international equities. Damian Sassower was brilliant yesterday on where do you find value in emerging market bonds. And time after time after time, you end up with some soup of resilient dollar, stronger dollar, diminished growth expectations off of what was looked at 6 months before. And that's right where we are right now. I'm going to go back to the IMF bombshell of April 6th. Are we framing out 3% global growth for 5 years? I don't think anybody is, including me.
Tom's on 105 watch on the euro.
Yeah, technically, you got to
For
be.
many people who have booked a vacation to Europe, based here in America, you're probably also on 105 watch.
And below.
106.80, but trying to get back to parity.
You know.
Just saying there might be some bills in euros that might need to be paid. And for those funded in dollars, this might be a welcome development over the last couple of weeks or so. The broader market story, equity futures on the S&P 500 shaping up as follows. We look a little something like this, negative by 0.2%. Yields coming in just a bit, Lisa, here. We're down 4 basis points. The 10-year, 364.
Today, perhaps we'll get jolted with some data and with some Fed speak. But before we get there, we're getting that House vote on the debt limit deal that we're not sure exactly when it's going to come out. It is expected to pass. Then the Senate has to take hold. Then it has to get through before the June 5th drop dead date. We're all watching closely every single iteration and just praying that it is over soon. Today, we also do get JOLTS data at 10 a.m. This will be really key to get a sense of job openings, the soft data around how quickly the labor market is softening. And at 2 p.m., the Fed releases This is the Beige Book, which Tom will read in detail. And today, if you are looking for Fed speak, Boston Fed President Susan Collins, Fed Governor Michelle Bowman, Philly Fed President Patrick Harker, and Fed Governor Philip Jefferson. Curious to see whether there is a Loretta Mester vibe or whether she is truly an outlier, because right now she seems like more of an outlier than anything else. Yes, you have heard a bit more of a willingness to push back against the idea of rate cuts. But very few people outright are saying, you know what, yeah, it does look like we need another hike. And, oh, yeah, we do need to tighten more. There seems to be more of a reticence around the edges and a pushback from some of the members.
Well, there's some splintering over the last couple of weeks. If you want to identify some consensus, two places. One, you mentioned, pushing back against cuts. Two, they don't want to commit to a pause just yet. You get a real sense of that on the committee going into next month's decision.
Especially because we don't know which way things are going to break. And this has been sort of the surprise. So the disinflation story, for example, the China story. We get the disinflation story out of Italy. We get the disinflation story, not Italy, excuse me, out of France. We get the disinflation story out of Spain. And then Italy comes and surprises to the upside with respect to inflation. So how do you really get a handle on what exactly is going on?
German inflation a little bit later as well. If you're interested in the views of JP Morgan's Jamie Dimon, conducted an interview with him overnight in Asia with our colleague, good friend Stephen Engel. Going to play some of that for you through the hour, so look out for that. Jamie Dimon on the debt ceiling, on China, and on US interest rates as well. Before we get there, we've got to catch up with Emily Rowland, co-chief investment strategist at John Hancock Investments. Emily, credit where it's due. I've been speaking to you all year. You push back against that Europe euphoria. You remain committed to the growth equity story. The United States over the rest of the world, not the rest of the world over the United States. Emily, are you sticking with it?
Yeah, John, we are absolutely. And it does feel like markets are sort of getting the memo right now in terms of the macroeconomic environment. You know, we're looking at decelerating growth, as you all have mentioned, disappointing data overnight in China. This morning, we saw Japan industrial production and retail sales both disappointing. And you've seen this big rotation into U.S. markets, and that's been exhibited by a lot of the cross-asset action, seeing a bid for treasuries finally over the last couple of days here. You're seeing the dollar get a bid. And of course, this massive rotation into U.S. quality growth stocks, which we've talked about for some time. So that's got some key implications for portfolios, especially if you think about, you know, some of these trend following strategies that have bought, you know, Japan, they've bought Europe based on positive price momentum. You might see that reverse and actually exacerbate some of the flows out of those areas of the market.
You're going to get me in trouble mentioning the trend-following strategies. Emily, I'm glad you mentioned Japan. We haven't mentioned that this morning, and those were shocking numbers. Within this is sticky inflation. Everybody's doing real analysis, but we live in a nominal world. Are we going to be surprised by okay revenue growth that supports U.S. blue chips?
Well, I think it's a great point because inflation has definitely helped these companies that have a lot of pricing power, especially companies that have high operating leverage. And we've seen that be absolutely critical in terms of supporting margins. We think it's going to be hard to sustain that going forward. Of course, bottom line costs are elevated, whether it's the cost of capital, wage growth still fairly elevated, though there are signs that that's coming down. And then clearly demand is starting to slow. We're seeing that way back in the supply chain. If you look at things like the ISM index of new orders, which is our favorite leading indicator. No offense, I know everybody has a favorite leading indicator, but that's ours at John Hancock. And that's going to put pressure on margins. It's going to cause companies to need to defend their margins going forward. And that's ultimately going to result in the unemployment rate rising. We haven't seen that happen yet, but we think that that's something that comes in the next couple of quarters here.
There's been a growing theme in a lot of the notes that I've been reading about this inflection point that we seem to be coming up upon, not that just that we've been halfway through the year, but also that some of the main factors driving the first half are shifting. Do you see that as well? And what are going to be the features of this inflection point?
Yeah, well, some of the main drivers that have been supporting the market, we've talked about it, was really China reopening back in the fourth quarter of last year and better weather in Europe, which caused this massive rotation into European equities. It caused the dollar to weaken, which really supported risk assets. There's been almost a perfect correlation with the dollar weakening and risk assets rallying and vice versa. And you're seeing some of those things shift now, again, as this rotation comes back to the U.S. The economic data, not great across the globe, but it's actually better in the U.S. right now, which is a big shift over the last couple of quarters. So stronger dollar, bid for treasuries. We think that's where some of the opportunities are from here. And I think that, again,
the market action of the past couple of days to us makes a ton of sense, given the fact that we are in a decelerating growth environment and that recession is likely to unfold.
Emily, great call so far year to date on the equity market together with the team. Thank you. Emily Rowland of John Hancock Investment Management. Just on the FX market, we tested some pretty extreme levels going back to late September across a whole range of currency pairs. Let's pick up on the obvious one. Euro dollar, the single currency, dropped to about 95. So right now, 106.77. I don't see anyone out there right now suggesting that we can go back to those kind of levels. But I think these kind of levels have surprised a lot of people too, because there were some calls about getting back out to 115 on the euro. This is where the growth story would be. Remember when I went to London a couple of months ago and every guest lined up to say ECB is going to hike more than the Federal Reserve this year? They may well do, by the way. That might still be the case, but the story in foreign exchange has changed over the last month.
End of May, this is sort of on my mind. I've mentioned it a couple times, and Emily Rowland mentions a slowdown in Japan. Obvious data in Tokyo, obvious data in China, obvious data in Europe, and this brings back within a terrible war this idea of the innovation, the buoyancy, the ferment of Europe. Is that belief still there, or will it be tested?
I would tie that also to China, right? I mean, how much of the enthusiasm and the upside surprise in Europe was a complete lack of understanding of the impulse of the reopening, where it would take effect, how much, and how quickly it would run out. And that maybe is where we are now.
This is important. That's a dominant German field, maybe with the Netherlands as well in their manufacturing, export-import dynamic with China. I would suggest Lagarde and the others of Europe are going to have to worry about the many domestic stories of Europe much more than China. It's going to be like, okay, what are we doing in Finland? What are we doing in Hungary?
Sure. Agreed. I think with regards to China, though, there was a misunderstanding around the reopening, wasn't there? Manufacturing wasn't shut down at that point. Re-engaging in services was where the boom was going to be, and that's perhaps what we should focus a little bit more on. Bob Michael at JP Morgan coming up in about 20 minutes. Looking forward to that. From New York City this morning. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank is hitting the final stretch of its interest rate hiking. ECB Vice President Luis de Guindos spoke to Bloomberg.
The news that we have received from several countries are very good, are very positive. They go in the right direction. Headline is declining. I think that we have run a very important part of the journey, and we are entering into the final stretch.
The ECB released its financial stability report today. Jamie Dimon says JP Morgan Chase will be in China in both good times and bad times, remaining committed to doing business in the Communist Party-ruled nation as political tensions grow. The CEO of the biggest U.S. bank also says he doesn't foresee a decoupling between the West and China.
Number of young people. Less trade. It'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
Dimon's remarks comes as China-U.S. relations are at their worst in decades. Photos obtained by Bloomberg show Elon Musk at a restaurant in Beijing. The Tesla CEO met more government officials on the second day of his trip to China, having opened his first visit since before the pandemic by emphasizing the importance of maintaining ties with the nation. Now, Musk is expected to tour Tesla's Shanghai factory later today. And a hacking group with suspected ties to an Asian government has broadened its targets to government agencies in countries including Indonesia and Thailand. And that's according to cybersecurity firm Group IB. It says the perpetrators, dubbed Dark Pink, infiltrated targets in 5 new nations using sophisticated malware and phishing emails. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I'm not sure what in the bill people are concerned about. It is the largest savings of $2.1 trillion we've ever had. These are major victories. I understand people get upset about walking through a debt ceiling, but this is a House, a Senate, and a presidency.
We're going to make sure that the country does not default, but we also are going to make sure that Kevin McCarthy and my colleagues on the other side of the aisle, of course, uphold their end of the bargain, which is simply to produce a sufficient number of votes.
Classic effort to spin on Capitol Hill. Speaker McCarthy there with House Minority Leader Hakeem Jeffries. Hakeem Jeffries, by the way, catching up with our colleagues on Balance of Power, Anne-Marie and Joe Matthew down in Washington, D.C. It's about shaping the optics. House Democrats want to turn around and say, we're not going to default now because we're going to bail out our Republican colleagues who won't vote for the deal that Speaker McCarthy agreed to with the President of the United States. You can see how this is going to go, Bramo, down in Washington.
Painful. And yet, when you take a look at some of the substance of the bill, you can really see how the sausage is made, whether it's with respect to that West Virginia natural gas pipeline on one hand, whether the fact that a lot of Biden's initiatives were rolled back. They're still going to try to spin this as a victory. It's sort of this interesting moment of really cross-political wins.
Frustrating, Tom. That's the politics of the moment for you.
It's not Tuesday, it's Wednesday. It's a 4-day work week.
It is Wednesday.
Thank God that. It's Anne-Marie Horton did that. She dictated that we have 4-day work weeks from now to
as she should.
Year. Anne-Marie Horton with us, Bloomberg Surveillance calendar correspondent here. She is exhausted like we all are by this battle. Anne-Marie, I want to go to the foolishness of this all. The Washington Post has Bishop of, I believe, the 8th Congressional District of North Carolina saying, quote, this is a career-defining moment. This guy won with 69.9% of the vote in the last congressional election. Our dominant Republican congressman throwing moderate Republican congresspeople under the bus.
Well, there definitely is a little bit of a schism at the moment within the Republican Party on the House floor. But by and large, Republicans do expect 150 of them, around that number. And this is what Hakeem Jeffries, the Democratic minority leader, told us last night. That is what he is expecting Republicans to come and vote for this bill. There's obviously the House Freedom Caucus. They had a press conference yesterday. You had one of them, I believe it was Chip Roy, talking about a reckoning that he wants. And this is potentially why you hear swirling of this idea that there could be this motion to vacate for Speaker McCarthy because they wanted deeper spending cuts. But by and large, the majority of the Republicans say, we understand, we only control the House. Democrats control the Senate. They control the White House. And in that environment, we were still able to get a deal, and they want to back McCarthy. But certainly, this is, a divide within their party. But that divide has been there for years.
I mean, look, Anne-Marie, again, I want to go back to these X number of Republicans that are, standing up. And I guess if the vote was the other way, it'd be the X number of progressives as well. I have no recollection in the past of people winning in their hugely dominant congressional districts, putting at risk their party, putting at risk their speaker. To me, to you with your study of this and you're expert at this, is this a modern occurrence that these basically Southern congresspeople are putting at risk their party?
Well, they're leaning into some of the rhetoric we've seen from the former president, which does have a huge hold still on the Republican Party, about 30%. Remember, it was the former president who at the moment is actually the one that's been silent on the debt deal. We've heard from some of his challengers like Ron DeSantis and Nikki Haley coming out and bashing it. He's been silent at the moment. We know that he has been in touch through reporting from Speaker McCarthy. But it's that rhetoric that he had said where if they don't get the deep spending cuts, you should just default. And it's that kind of tone that many of these on the far right are taking, and they're taking back to their district.
Lisa, Ray Norman, South Carolina, over 60% of the vote in the last election. I mean, these are dominant winning Republicans. And I just wonder what they're doing to the moderate Republican group. To me, that's the story.
Which really feeds into the point, Anne-Marie, that you brought up with Ron DeSantis backing, or actually slamming this bill, not backing necessarily Kevin McCarthy. How much is the whole move to a middle not really the dominant theme when you take a look at the general election, when you take a look at the Republican and, frankly, the Democratic parties?
Well, that's how it goes, right? In the primaries, you go as hard as you can to your party's right or left. And then if you win it and you go to the general, you try to become a little bit more moderate as much as you can. I think one of the issues the governor is going to have as he kicks off this tour in Iowa, giving a number of speeches, attending a number of events, is when he bashes the debt ceiling bill. He was a member of Congress at one point not too long ago and voted to increase the debt ceiling without the deep spending cuts that he's now talking about. So this could potentially also hurt them, but this also just makes sense, right? They're all trying to play to a base The former president has 30% of the Republican Party, and anyone that's going up against him and trying to challenge him is trying to knock at that 30% and trying to be someone that they think the rest of the Republican Party can coalesce around.
Meanwhile, we are hearing about new entrants into the Republican primary, potentially with Chris Christie of New Jersey potentially getting in on the game. What does this tell you, not necessarily about Chris Christie potentially winning, but also just with respect to the field?
Yeah, I think Axios reporting today that he plans to announce as early as next week. There was reporting earlier that, there's a super PAC building behind him. I think it just shows that we are a long way off from the U.S. election. It is next year in November, and you're going to see more names start to come into the race. I also think it's potentially a question mark on Governor DeSantis, which many thought he was going to be, the heir apparent, if it wasn't going to be Trump, that could take on this race. Obviously, you've seen mega donors hit pause on him. There seems to be some concerns with whether or not it's taking on one of Florida's largest employers, Disney, whether or not his backtracking and how he feels about Russia's invasion of Ukraine. That definitely starts to irk and make, the hair on Republican hawks start to rise. Then potentially others are starting to say, maybe there is a path for me. And it's not just Governor Christie, former Governor Christie, who we all know what makes it complicated for him is that he actually was a huge Trump ally, and now he goes on and bashes him and definitely does not agree with the former president. But others, there's reporting that Glenn Youngkin, the Virginia governor, is also taking a second look at potentially getting in this race.
So, AMH, you've got this anyone but Trump in the coalition of that within the Republican Party, and they're all diluting each other. They're hardly being heard. At some point, don't they all have to get round a table and decide who is going to be the challenger?
Yeah, I think one of the most interesting things Governor Sununu told Joe Matthew and I was early on, he said, what is so important about 2024 is when do you get out? Sure, open the field as wide as possible, make the scope and breadth of this race as wide and fruitful as possible. Let's have a proper debate, but know when to get out so that everyone can coalesce around someone else that is not the former president. The issue, of course, they all have is the former president just sucks up the oxygen in the room. Look, DeSantis is in Iowa, and he's trying to make this push there. Yeah. The former president is going to Iowa today. He's having a town hall with Sean Hannity that's going to air tomorrow. Very difficult for anyone to try to break through.
When do we get the next poll that shows how foolish this discussion is? What is Chris Christie polling? 2%?
Narrow. What I'm seeing right now, and I'm pulling up Real Clear Politic, is a very, very narrow margin. Narrow market for him.
I yearn for London politics. I mean, it's just like...
Can be brutal, though, Tom.
Well, it's short. It's easier.
The best thing Anne-Marie said there is the election's a year and whatever away.
I know.
And we have, 14 Republican candidates?
It's more time for people to stand up.
You mean Lisa could run far
I'm
left
going
of
to
the
announce
Republican group.
Right now that I am not going to run for office.
AMH, thank you. I know someone who might.
Yeah.
JP Morgan's Jamie Dimon. I love my country, and maybe one day I'll serve my country in one capacity or another.
Really not slamming down speculation of a run when a lot of people
It's
have
the
talked
greatest
about that.
trade in the world.
What?
You leave the bank, got all those shares, become the Treasury Secretary just for a heartbeat, and you make that trade. Oh, it's beautiful. Tax-free. Tax-free.
You think that's going to happen?
He's a patriot. That's not what this is about, okay? Be serious.
Okay, hold on a second. Do you, okay.
Equities closing out the month of May, just a bit softer. Year to date, though, much better than anyone anticipated. Month to date, pretty decent too. On the Nasdaq, at least. On the Nasdaq 100 this morning, down by 0.2%. On the month, up by more than 8%. What a run that's been. Left behind the equal weight S&P 500. The market cap weighted stuff just about negative this morning by 0.3%. And this has been developing, and we've talked about this a million times over the last several weeks. This move in the Nasdaq has been developing even with this move in the 2-year, in the bond market. Take a look at Treasuries this morning. Yields come back a little bit by a couple of basis points, but the fact we're at 442 and up on the month by something like 40 basis points, and still we've managed to grind out a gain of more than 8% on the Nasdaq 100. You can thank the likes of Nvidia and others for that one. Thank China for this one. A weaker euro. PMI's out overnight. As soon as they drop weaker, bang, Euro weaker too. 106.83. Break of 107 in the last 24 hours. Haven't seen 108 for about a week now. Will we see it again anytime soon, based on the incoming information we're getting from China at the moment, Lisa, which is weak growth, weak growth?
And how much is this really going to drive the narrative for the second half of the year? The first half of the year really was dollar weaker, China growth, then weaker China and dollar strength. Do we get sort of the opposite coming in? I'm looking at some specific names. We want to look at Nvidia. It has soared 31% over the past 3 sessions. It's taking some profits right now. You can feel that kind of churn right now. That's not going to drive the market, and that's why perhaps you're seeing a bit of sogginess in the market. Hewlett-Packard Enterprise, I think, is interesting. Those shares lower by 8.3%. Those shares largely down on the year already. And what this shows to me, yes, they had second quarter revenue and current quarter forecasts that were below expectations, but still, to me, it's the have and the have-nots. It's not just a tech story. There are some pretty big losers underneath the tech story, even still. And Avis up after Deutsche Bank recommending that people buy simply on a valuation story. Those shares are lower on the year, even though people have been renting cars. Again, what I find interesting is the churn. These stories that people are just looking to pounce on maybe for a day, 2 days, for a valuation story, not necessarily because of a fundamental issue.
We call that a valuation trap, is what we call that.
Well, what this is called is a market that doesn't have a clear direction. And even if you have a clear view on the economy, it's not clear that the market will cohere with that based on some of the big drivers of the gain so far this year.
Car rentals are just a money pit, right? You notice that? You turn up. Sticker price is never the price, particularly in Europe. I have this difficulty. Whenever we used to go as a family, it was always problematic. You go to Europe, I'm not going to pick on a name, Hertz, Avis, whoever you want. You go over to Europe, it would always be a problem. It would never be the sticker price.
Of course not. You have all the fees. If you get sucked into the insurance, the extra added insurance based on your own insurance, if you're going to do that, that's another fee. If you have gas or not gas, all of these like questions, you sort of no. And then if you crash the car, you're screwed.
You get into the parking lot, family of 5, Fiat 500. You know, that's always the way. I can see my childhood. Slew of Fed speak today. Collins, Bowman, Harker, Jefferson on tap. Cleveland Fed President Loretta Mester speaking to the FT and saying, quote, I don't really see a compelling reason to pause. I would see more of a compelling case for bringing rates up and then holding for a while until you get less uncertain about where the economy is going. Here's some good news. Bob Michael takes the other side of that, of JP Morgan Asset Management, saying that we are going to get a pause. We expect the Fed to pause hiking rates at the June FOMC meeting and believe we have seen the last rate hike for this cycle. And the good news for Bob Michael is it sounds like his boss agrees with him. Take a listen.
You know, my simple view is that, you know, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more.
Take a pause. It sounds like a Fed official. Ready to go.
No, he looks like
Treasury
Secretary.
Secretary. Right, okay.
He looks Mellon-like.
Ready to serve the country.
Andrew Mellon, yeah.
Yeah.
Did you see Bob Michael as undersecretary?
I can see that happening.
I can see that. Joining us now, Robert Michael. Bob Michael, head of fixed income, JP Morgan Asset Management. And I want to go back to 1984. You're a youngling at Bankers Trust. Ian Rush is with Liverpool. They're doing better than good. This is way, way back. And the basic idea is we used to clip coupons. Would you be sitting with Mr. Diamond now saying that we can make coupon and total return now? Are we going to see price up, yield down in a basic bond portfolio?
I can't tell you how relieved I am not to hear him tell me that I should be preparing for 7%. So I'll take what I can from him, that we're due for a pause and that should relax the markets. No, 100%. This is the time where you clip coupons because yields have reset materially higher from where they were at the end of 2021. Actually, when you look at real yields in the bond market, they're the highest level going back 15, 17 years. We're going to get some capital appreciation on top of the coupon clipping. I'm looking for close to double-digit returns on the Bloomberg aggregate over the next year.
This is the key statement, and what's important about this is Mr. Diamond back to Bank One actually knows what an S&P Blue Book is. I mean, you have a Blue Book and you have bonds in it, and you go through and you try to buy bonds for price up, yield down. Which kind of bonds will give you the best pop there to get your double-digit return?
Well, we're certainly intermediate government bonds look good to us. So we're thinking the 5-year Treasury. We feel we've been given a gift in here with the backup in yields. Sure, we swung a little bit low in yields. The market got all excited. Now it's going the other way. We do think that we're going to see 3% across the coupon curve by the end of the summer, and the 5-year seems to be the sweet spot. So we like that. And then we like high-quality credit. So for sure, we're going into investment-grade corporates. We're actually starting to see a lot of overseas investors returning to the U.S. investment-grade corporate bond market. They're attracted by the yields there.
The yields here, John, and it folds right into the disinflation, deflationary Chinese impulse.
Let's unpack some of this.
Huge statement.
Just on the yield curve, for people who aren't familiar with what drives different parts of the yield curve, what is special about a 5-year maturity? Why is that the sweet spot for you?
Because it gives you a couple of things. One, it gives you a reasonably high level of yield. Sure, it's not cash. Cash is sitting out there at over 5%, but that's the cash trap at this part of the cycle. You put money there, and then a year from now, it's gone. Your cash run rate is probably below 4% a year from now. So you've lost all of that, and then the yield curve starts to adjust to a central bank that's cutting rates again. We still think we're going to be in recession by the end of the year. Everything that's happened so far this year continues to tell us end of the year recession and first Fed rate cut in September. And I know the recent data throws some of that into speculation. Not in our book. Things are playing out the way they should exactly.
So 5-year in the Treasury market, one, got it, okay. IG, tons of demand coming from abroad, got that okay. High yield, you've got within your call a rate cut call in September. Does it make sense to be buying high yield and taking more credit risk at a time where the Fed's going to be cutting rates because you anticipate the economy is going to weaken?
So I'm listening to the conversation at the start about the equity market and how we're isolating Nvidia, and a couple things have driven this rally, but there are other things that are lagging. Now, I'm a bond guy, which makes me an equity market expert, but I see a lot of I see a lot of I see a lot of what's going on in the equity market and the high yield market, and we've parsed through all of this. And what you're looking at is the CCC universe is 1,000 basis points over. So it's already coming under pressure. And the BB universe is in the 300s over. So that differentiation is already occurring. This is very different than where we were back in August, September. Whenever we hit 600 basis points over, pretty much most of the market was about 600 basis points over. That was probably the time to take a shot over the near term. Now is not. Now the market is telling you there is differentiation beneath the surface. Investors are seeing cracks forming, and they're trying to get out of the way.
You said that things are playing out as they should to get to a recession by the end of the year and to get a Fed to cut rates by September. Does that mean that we're in this sort of inflection point, that we're going to see a rapid deceleration in some of the economic data in a way that we just haven't yet with all the upside surprises?
Absolutely. And we've talked about this before. From the last Fed rate hike until recession, it's historically averaged about a 13-month period. So that long and variable takes time. We're now getting into a year and a quarter. We're going to start hitting the window when the 475 basis point rate hikes start to hit. And you're already hearing about the funding pressure to businesses and households at a higher rate level. It's causing them to rethink things. And then the higher cost of everything, that's causing them to rededicate where their spending goes to. So that catch-up is coming. In some of the inflation data we're looking at, Europe overnight or this morning came in soft. And I know Italy surprised a little bit to the upside, but everything seems to be slowing down. The one thing that seems to have gone under the radar, forget about what's going on in China, look at the Bloomberg Commodities Index. It was 140-ish about a year ago. It's below 100 now. And the trend is diving south at a rate that you only see headed into recession. So the weakness is there. The cumulative and lagged are catching up.
This is important. A lot of people push back against commodities being a real signal this time around. They say this time is different with a lot of different things, and I could see
right. You don't use them for anything.
But hold on a second. But here's the issue. People saying that because of China and the inability to get that right because of Russia and their willingness to pump much more than their allotted amount to try to get money to fund the war. Because of all of these issues, you're seeing distortions in the commodity market that do not comply with what you're seeing on the ground. How much are you using this as a key signal saying we're where we should be?
Well, you still have very low unemployment in the U.S. Everyone's talking about 3.5% unemployment. Everyone's talking about wages have gone up and that there's a stickiness to core inflation. Everyone's talking about consumers want to spend on travel and leisure, so that the demand is there. But if the demand is at a high enough level, you are going to see commodities prices pushed higher. People are spending on things and buying things. It's just not at a rate that sustains itself with the amount of supply we're now seeing. The bottlenecks have cleared.
Bob, this is awesome. We're going to talk more about this. Bob Michael at JP Morgan Asset Management is going to be sticking with us. This long-held view over the last several months, Tom, that I think has got your attention, my attention, Lisa's attention as well. It's the whole curve back down to 3%, and these cuts come in September.
A number of houses have this call, and with it, optimism, price up, yield down, but I would say it's an outlier call right now. I mean, I think people are just inured to these high yields that we see, and maybe they drift away with the debt ceiling getting fixed, but we're going to come back and talk about this. It's important.
That conversation coming up shortly. Right now, your 2-year at about 4.42. Right now, your equity market near session lows, just off them. We're down by 0.4%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. Meanwhile, JP Morgan Chase Chief Executive Officer Jamie Dimon says he's optimistic about it.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Now, Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. South Korea's spy agency says North Korean leader Kim Jong-un may be suffering from a sleep disorder. The National Intelligence Service says North Korean authorities are intensely collecting overseas medical information for top-ranking officials with insomnia, including details on medications used to treat it. Meanwhile, North Korea has confirmed that an effort to launch a military spy satellite into orbit failed. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. I'm Lisa Mateo. This is Bloomberg.
When we do business in the country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself.
JP Morgan Chase CEO Jamie Dimon back in Shanghai. Not the only one this week, actually. Not just JP Morgan's Jamie Dimon, but also Tesla's Elon Musk over in China as well, talking to the government. We should go too?
We should go.
You'd like to make that happen?
Do the show on top of the Peace Hotel at the Bund in Shanghai.
Isn't it nighttime?
Yeah, but, sun setting, through the
romantic.
It's very romantic. I was looking at our Hong Kong building once, and I saw the rain coming in, and the lovely next to me informed me, Tom, that's not rain, that's smog. No, the rain was coming in, John.
I've heard this story
smog.
before. Yeah,
You
told me that. Yeah.
Okay.
Yeah. You know, like old jokes recycled.
Yeah.
Yeah. Okay, let's.
We gotta move forward.
Granddad, we did this. You told me 5 minutes ago.
John,
you know?
John, save me. John, save me. Euro 106.82.
Okay. What do you want me to say about it? Data out of
It's
China.
a big deal.
Data out of China weaker than expected overnight. And you can plot the chart, by the way. Just go intraday, look at the time where the China data dropped, which I think was like 9:30 Eastern time, and you can see straight afterwards, Euro, boom.
Oil 67.54. We continue with Bob Michael. What a pleasure to have him for the entire half hour ahead of fixed income. JP Morgan Asset Management. I want to recapitulate what you said in the previous section. You are looking in the vicinity of Labor Day for a 3% market. Nobody listening or watching believes you. That's massive price up, yield down, isn't it?
It is. And, you know, we talked a little bit during the break about 2008, and I want to go back to that because March to June 2008, while the world's property market was melting under our feet, the 5-year Treasury went from 2.20 to 3.75%. It rose 155 basis points. This time, 75 basis points, it's laughable. So you can have these counter-trend sell-offs in the market, but the broader trend is growth is coming down, inflation is coming down. The peak in inflation, the peak in bond yields was last year. We're going to have lower highs and lower lows.
And John, this folds right into that stunning headline a couple weeks ago from John Williams of the New York Fed, looking at an R-star, which is a lower rate regime.
Before we get there, I want to talk about what's happening in the property market. It's one of those things that we can all see in commercial real estate. We can all see it with our own eyes, what's developing in cities across this country and elsewhere. And then you speak to professionals in the market who know about CRE and this important stuff that I don't get. They tell me everything's okay. It's going to be all right. This isn't going to be a problem. There's no crisis here. What do you see?
I see an imbalance. I've traveled through the U.S. a lot this year. I've been to 9 cities. Suburban office space demand is very, very high. But when you go into central business districts, the offices are empty. And those used to be flagship properties before COVID hit. So I go back to 2019. I think about all the commercial mortgage-backed securitizations we bought. I think of the REITs that were put together. What you wanted to see in there was central business district office space. It was 99% leased. And what's going on now is there's nobody in these buildings, but the leasing rate has dropped from 99% to 85%. So the appraiser comes in and revalues it for that, not for the fact that as more leases come due, they're not going to roll over. So I do get very concerned about that. It again reminds me, and I don't want to keep going back to 2008, remember the subprime residential real estate market? It's so small. It's not the U.S. housing market. It doesn't mean anything. And I'm hearing the same garbage about central business district office space. It is significant. It was the flagship trophy properties, and these buildings are still largely empty in too many cities.
The big pushback that I hear from people when I raise this concern is this time is different because the leases are much longer. It will take time for them to roll over, so there's some capital that's been locked in. A lot of the revaluation has been happening already in a very controlled way, and there are bidders that are coming in. How do you push back in the sense that this might not be necessarily a slow rolling depreciation that can be controlled into something that will force the downturn to accelerate and the Fed to cut rates?
I think at some point in time, the cost of carry is too great. And I think about Houston property in the early 80s when everyone talked about, oh, you know, oil price collapse. If you could just afford to carry this property, you could make a ton of money. And guess what? You couldn't. People were going to the sale of their homes and writing checks for somebody to take their house. So yeah, Houston property came back in a big way, but at some point you just get tired of carrying the property. We're seeing some of that already where you see the property holders in some commercial mortgage-backed securitizations go, you know what, here's the level of debt, here's what I think the properties are worth, here are the keys, good luck to you.
So just to put a bow on this, There is this issue of whether you think that commercial property devaluation is what's going to trigger the Fed to be forced to come in and cut rates, a call that is out of consensus at a time when the Fed wants to push back against just that kind of idea.
Well, it's not just commercial property. I'm not sure how we wound up there, but there are a lot of other things going on, right? The regional banking system is still on life support. Many of the regional banks have their entire securities portfolios on repo to the Fed at par. And they're trading in the 90s, and they've got that cash at par sitting there to meet depositor outflows. Their loan portfolios put in place when SOFR was 1/8, not 5 1/8. Those are underwater too. Those are now with the Federal Home Loan Bank, so they have cash to meet depositor outflows. We'll know in 2 months from now, when we get bank earnings, what's happened with depositor outflows. My impression is there's still outflows at the regional banks. We don't know how the regional banks will operate until the Fed, the FDIC, the Federal Home Loan Bank are out of the picture, and we're a long way from that. Commercial properties, the second. The third is just the cost of funding corporate America. As I said, you had an infinite pool of free money available for several years. SOFR was 1/8%. Sure, you're a below investment grade borrower, slap a 4 or 5% credit cost on it. There's your 4 or 5% borrowing rate. Now you're in the double digits, and more of that will be rolling through. I think those are the concerns out there. I do look at the commodity index. I do think inflation is going to fall off a cliff here. And I think the Fed's got this wrong.
You've got 60 seconds left. Huge amount of T-bill issuance is going to come very shortly. Just quickly, with everything you've just said, is that a problem?
It shouldn't be. I'm hoping that it gives banks and money market funds somewhere else to put their money other than overnight reverse repo with the Fed. So maybe that will give us another avenue to invest.
Bob, this was a clinic. Need to do this more often. Come into the studio again. More guests coming around the table for a couple of blocks.
It's fun.
You know, it's fun. It's good to see you.
They come to Midtown, they talk about the crisis in commercial real estate because it's all emptied out. I mean, that's sort of the issue.
We're the only people around.
Exactly.
So they just want to drop by and have a cup of tea and chat. It's lonely out there.
John,
it's lonely out there in Midtown Manhattan.
John, my anecdotal is it's at least the same, if not it's gotten worse. I don't know what the cheerleaders are saying right now, but it's stunning just to drive through Midtown.
Well, they like to look at what's happening with the subway and what the volume looks like there, and at the airports and that stuff. Look, I see the offices. We all see it. There's no one around.
Yeah. Not in the offices. They are, going out to eat. They are. I mean,
this was
that's
James
the thing.
Gorman's problem, wasn't it?
But that's exactly it. I mean, people are still going back to the cities in droves. It's just not the offices.
Oh, I see them out in the town on the weekend.
Oh,
sure.
I
mean, this was what James Gorman and Morgan Stanley said. The restaurants are still packed. Be very clear about that. The restaurants are still packed.
Yeah.
The offices are not. I'll say this, Bob, don't worry, we'll let you go. The banks, I love the banks who say that we've got to get back to work. I saw a wonderful take on this. Get back to work, but then it comes to banking and they cut branches because you don't need to do banking in person anymore. But you do need to do banking in person within the bank. Just, you can do it remotely.
I'm biased with this. Yes, but I'm biased with this.
If you're the client, the customer, you don't need the branch anymore, I'm told. But if you work there, you've got to be there.
You hear some frustrated people. Is that what I'm
Because the culture's important. The culture's important.
Boy.
The economy's in a bit of a weird spot, right?
I'd say that these markets are playing out as you would expect them to play out.
We're concerned about the equity market because it has had such a strong run.
The big shift has been equities and bonds becoming positively correlated.
The U.S. economy is in a very different place from the rest of the world.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. A China slowdown, a commodity slowdown. Bob Michael looking for 3% yields out to Labor Day. And John leading the way in that commodity slowdown. American oil, $67.53. Nothing else has to be said today.
Well, welcome news for some central bankers, I'd say, Tom, for price pressure. Germany just out with inflation, looking at inflation coming in below expectations and well south of the previous month as well. You put it all together, though, fact of the matter is we still have a 6 handle on CPI over in Germany, Tom, and the pressure will be on the ECB to hike once again on June 15th, I believe.
The vector going the right way in France, in Spain, now in Germany, and Emily Rowland mentioning with John Hancock earlier, Japan out with a slower set of economic data today. That is the trend of the morning, again seen in oil and that weaker euro.
Growth is going with it, and as anticipated, and front and centre are those PMIs out of China overnight. Manufacturing well south of 50 now. That's the line in the sand between expansion and contraction, and clearly in contractionary territory, both in China and in Europe too. And that's why, Tom, we've got a euro that's back down to 106 and not north of 110.
And what's fascinating here, Lisa, is the response. I guess as we talk about the response from the Fed. You've got a whole bunch of Fed speakers today. The response from Europe, the response from Lagarde. How does Beijing respond to this, given the politics of the moment?
The question around stimulus and how much ammunition they actually have. We heard from Bill Lee that they don't necessarily want to increase their debt limit. Jamie Dimon was pretty positive, continuing to be diplomatic and be there. John, as you pointed out, they might be more targeted with respect to how they stimulate specific industries. The larger takeaway here is, yes, disinflation, but the flip side of that is, as you were talking about, slower growth. So are we on the tipping point? I keep going back to this tipping point of just sort of a moderation, an immaculate disinflation, or something that's a little bit more violent, akin to what Bob Michael was just talking about.
We've still got a massive distinction between manufacturing data bad and services data pretty decent. That's true in Europe. That's true in the United States, and in some way, shape or form, true in China too.
Which perhaps is the reason why you saw Italy, for example, surprised to the upside with respect to how much inflation was coming down, because maybe there's more of a services side of the economy and less of the manufacturing side. And Germany is going to disappoint. The point here is, how do you put these together? Which is going to catch up with which at a time when people are still flying around at an incredible pace?
Still pandemic economics. Still, we had this massive pull forward of demand of certain things. Goods, we wanted to buy stuff. We had to push out demand for services, couldn't engage with the economy in quite the same way. Go to an airport at a city near to you and you'll see what we're talking about.
Yes.
Bramo, you lived it over the weekend. It's kind of crazy right now. So services are screaming, let's go hike. Manufacturing screaming, let's go cut. And to your point, how that settles out in the coming quarters is going to be the story, I think, ultimately for the year.
And just when you take a look at forward-looking, we didn't even mention this, American Air came out and basically increased its expectation for its earnings because of exactly that kind of trend. You take a look, though, at what's going on in the commodity space, and it does raise a red flag that's hard to ignore. And I think that's the reason why people keep gripping onto it.
Exclusive Nvidia, under $1 trillion.
There we go. We're tracking that one closely. Where are we now, Tom?
394. We're down 1.7% off yesterday. But, it's amazing how 24 hours ago it was about AI and tech to the moon. And now we're looking at that global slowdown again back to April 6th and what IMF called for.
Well, I think it's part of the same story, isn't it?
Yes. I think that's a really important concept of, frankly, technology substituting for so much more. And that's how you get to that manufacturing
We were all
slowdown.
Searching for growth over the last 10 years, and we found it in equity stories. And that was basically the FANG story of much of the last decade, Tom, with low levels of growth, inflation, low rates, all of the above. What's been curious about this year is we came into this year, and I think we've kept going on about this, about how we've just eaten away at consensus views, just hammered away at them. Year to date, tech, not going to do well. Last year was ugly. Guess what? Tech, ripping. Nvidia, fantastic. Consensus view, China reopening. That's where you want to be.
That worked out.
China, equity market, bear market. The dollar, get short the dollar, get long the euro.
That worked out.
The euro back down to 107.
DXY.
Take your pick. Just kind of beating up on consensus positions across the board.
Can I just apologize to whoever's watching this and just throwing things at the screen? Like, why? Why are you having to pick on me? But it's so many people.
We're coming up tomorrow. We're going to have our sell in May and go away summary here. And I'm sorry, that's what the data is. And John, you see it in DXY 104.42. Give us a little bit of data here.
It's sun in May. NASDAQ 100 up 8% for the month and some. Pulls back a bit. We're down about 0.4% on NASDAQ futures this morning. On the S&P 500, similar move on the S&P, and we pull back on yields. Down by 4 basis points, Tom, 364.
Alex Chaloff to provide clarity here. CIO Bernstein Private Wealth Management is way. You got to write a mid-year review, Alex. What do you do here? How do you change from 12/31 after the surprises of the first 5 months of the year?
Yeah, Tom, actually, I'm going to have ChatGPT write the first paragraph of my mid-year review, and then I'll write the second one, and I'll just throw it back to our Bernstein clients to tell me which one they think does a better job. But look, we're clearly in a transition period. We're going to have an earnings recession in the back half of the year. And I know people in the financial services industry always talk about the back half of the year. It's never now. It's always, oh, in the back half, this X, Y, or Z will happen. But it's clear that earnings have to come down from where they are. Markets pricing in 2024 more than it is 23, looking past potential pause, potential hike, one more priced in, looking past the debt ceiling morass, which we would agree you should look past. But this is all about next year at this point. I think that's part of the reason why the market's behaving the way that it is. Investors are looking to next year.
What are people getting wrong right now? And I say this with great humility because everyone seemed to get everything wrong heading into this year, including us, including myself. I'm just wondering from your vantage point, where potentially the framework could be off.
Well, I think that there's a broad narrative that the market, air quotation mark, is up. And it's true. The S&P obviously is up nicely this year, but it's probably the thinnest rally that we've seen forever. Just a couple minutes ago, I was on my Bloomberg, and I put in SPW Index GP Go, and that's I should have said that to do that earlier, but that's the equal weighted. If you look at that index, it's negative for the year through last night. So S&P, the market cap is up 9.5, but the equal weighted is basically 0. That's a 10% spread. So I think what people are missing, oh, there you go. Oh, that's the futures, never mind. What people are missing is the fact that it's not the market that's up, it's just a handful of companies. And so there are attractive opportunities outside of things that have really moved. And I would argue it's maybe a little bit early, but time to fight the momentum trade and look at other areas that should benefit over the next 12 months.
Are you going more into bonds? And I'm piggybacking off of what Bob Michael of JP Morgan was just talking about, this idea that we could end up at a 3% level for the entire yield curve with people piling into bonds, the Fed cutting rates by September, and a full-blown recession underway by the end of the year. Do you take that view as well?
Full-blown recession is probably a little bit overstated. But your original question, are you going back into bonds? We never left bonds. We have weathered the storm in bonds, particularly in munis, and have enjoyed the rally really since last fall. I think that's the secret that not a lot of investors have appreciated, that munis have been really quite strong over the last 7 months. If you look at what's going on in the bond market today, you're definitely, the yields are much juicier than they were a year or 2 years ago. The credit issues, I would say municipals have come off the board. You've got to be very picky in corporates, be very selective around credit. But there isn't the risk of, in our view, a deep recession. We will be in recession. Our view for U.S. GDP this year has a negative on it. It's negative 0.1, but it's basically a 0. And to get a 0 for the full year means the back half is a recession. But our view is that the strength in the labor markets is much stronger than any of the other negative forces. And we muddle through and we get through to the other side.
It's amazing to see 3.4% unemployment in America still. Alex, we've got to leave it there. Alex Sholoff there of Bernstein Private Wealth Management. Just on that distinction, that difference between the outperformance on, say, market cap, S&P. Take the Nasdaq 100 this month. If you're just tuning in, I'll go over those numbers again. It's up more than 8% this month. Equal weight S&P is down 3% month to date. That's 11 points of outperformance, Tom, in a single month.
And by no means am I saying buy, hold, sell. Everybody knows I'm very comfortable in triple leveraged all cash. I looked at Procter & Gamble. I looked at Walmart. These are stocks, John, trading at 20 multiples, huge multiples given their revenue growth, the stolid nature of what they've got. Take a troubled company. We all know 3M is troubled. They're down 62% from their 2018 high. They're down 47% since the beginning of last year. And let me tell you, there's no bid on the stock right now, pricing back to 2013. You can enjoy 3M this morning at under a 10 multiple.
Wow.
I mean, it's trading like Ford Motor Company. But is that how you describe a value trap? And again, I don't want to go into buy, hold, sell here. I'm just saying within security selection, what's really the value of a 12 multiple now or a 9 multiple? You got to be careful out there.
Or on certain stocks where multiples just don't seem to matter at all. like Nvidia, which is just absolutely flying. That's the equity story on bond markets. We'll catch up with Jean Bavin of BlackRock in the next hour on Bloomberg TV. Got a very, very interesting call. Fixed income is back. Hear that a lot. Fixed income is back. The income part of fixed income is back, yes. But do you get, or will you get, the inverse correlation to risk assets to diversify the portfolio? Now, what Jean Bavin's got to say on the bond market is, yes, for income, front end okay. What he's saying further down the curve, because he thinks inflation is going to be sticky and the Federal Reserve won't bail people out with rate cuts, he's saying that the 10-year won't give you that performance in quite the same way. I find that interesting.
I find that fascinating. It goes against what Bob Michael is talking about, but it's this fear that the 60-40 won't work. And a lot of people are sticking with that belief and looking for diversification in other ways.
That's tricky. Right now, equity futures just a little bit negative on the S&P 500, going into the opening bell to close out the month of May with another big month of gains for tech stocks.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. Meanwhile, U.S. House Speaker Kevin McCarthy has dismissed threats from Republican hardliners to remove him from his job. The U.S. and European allies urged caution on whether Ukraine should have the right to strike inside Russia. Countries supporting Ukraine are taking varying stances on how it should beat back Moscow's invasion, as Russian territory is increasingly targeted. The U.S. has publicly leaned against the strategy of attacks within Russia. Foreign ministers of the North Atlantic Treaty Organization countries began a 2-day meeting in Oslo. Well, they'll discuss Ukraine's bid to join the military alliance, as well as how to boost defense spending. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. Biden administration officials are divided over how aggressively new artificial intelligence tools should be regulated. Some White House and Commerce Department officials support the strong measures proposed by the European Union for AI products. Meanwhile, U.S. national security officials and some in the State Department say aggressive regulation will put the U.S. at a competitive disadvantage to China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done. I think it's going to happen. If I thought it wasn't going to happen, I probably wouldn't be here right now.
It goes to a vote in the House, and Jamie Dimon of JP Morgan thinks that vote will pass, as do many other people. The fact of the matter is he's in China and he is not in the United States. And I think most CEOs share this view right now, Tom, that this thing will pass.
Yeah, I think after the vote yesterday, Emery Horton said that was very important. I believe it was 7-6. I mean, 7-6 is the same as 10 to whatever. I mean, the fact is it passed.
It's tight, though. It's tight. Yeah, I'm with you. It's just funny. I think Jamie Dimon alluded to this, that ultimately this has become the mechanism to actually have a negotiation about the budget in America, because we don't often do that, Tom, do we? The White House comes with a budget and everyone's like, budget, nah, whatever.
I agree, and there's a cardinal rule: fiscal policy doesn't matter in elections. That's tattooed to everybody's brain, both sides of the aisle. The first Tuesday in November, debt, deficit, budgets, it's not up the chain of issues.
I'd say the other way around.
Emery Horton taught me that.
It doesn't seem to matter when you're in power. It seems to matter more when you're out of power. Have you noticed that's a trend?
Nobody wants to come out and say, we're going to cut your Social Security checks. That is basically political kryptonite. But there is this issue, and we're going to hear this more, and we did hear this from Ron
Right.
DeSantis. How much is this going to be a talking point this time around?
We're going to go to the congressman from in between the Cubs and the Brewers, Janesville, Wisconsin. Brian Stile joins us now, Republican from Wisconsin, with all that heritage of former Speaker Paul Ryan. Congressman, I'm going to go back to the election of 2018. You won with 51, maybe 52% of the vote. You've done better in recent elections, doing better, like 60% or whatever. I want you to comment on the vociferous conservative Republicans and what they're doing to Republicans who are more middle of the road. What is the damage being done by the strident Republicans to those more in the middle of the road?
This vote is going to be a little bit of a vote of strange bedfellows. I think what you're going to see is at the end of the day, there's some members that are going to allow perfection to be the enemy of the good. All of us, I think, would like to see us get our true fiscal house in order in the United States. This bill is only a step in the right direction, but it's a step in the right direction. It's the largest spending cuts that we're going to ever see in the United States of America. It has work requirements. It helps workers get back to work. And it does all this without raising taxes.
Right.
And so at the end of the day, there's some people that would like to see a perfect bill. But I think if we have a good bill, you got to vote for it.
Congressman, Jim Garrity in the Washington Post had a brilliant half paragraph yesterday which said, look, the Republicans have a narrow majority in the House. Can you expand that power in Washington with President Trump after this budget debate? Can you get there with Donald Trump in November of 2024 to move beyond a narrow majority in the House?
I think what we're going to see now to the election in 2024 is a lot of voices coming to the table. And I think the one that's going to be successful is the candidate that's going to talk about the future of the United States of America, about how we're going to grow the economy and address the fiscal situation that we're in. We're going to have a number of voices at the table. I don't think that's a bad thing, because I think we need to dramatically change course in Washington, in particular following 2 years of dramatic increases of spending.
A lot of people talk about the real discussion being entitlements and whether Social Security checks are going to have to be reduced, whether Medicare and Medicaid are going to have to receive less funding. Are you putting those things on the table in your discussion about further fiscal restraint?
In this bill, we're only really dealing with 11% of the federal budget, and dealing with 11%, we got $1.5 trillion of savings for the American people. But you're right, at the end of the day, it's the entitlement programs that are driving costs higher. This is going to be an opportunity here to bring Democrats and Republicans to the table to address those programs and truly protect, in particular, Social Security and Medicare for generations to come. But that's going to require a bipartisan approach of folks coming to the table, encourage of candidates who are running for president in 2024 to talk about the reforms that are ultimately going to be needed.
There's a large question around whether that will actually happen, and we've been having it with a lot of cynicism. I'm sure you have your own with insight from inside the Beltway. Wendy Schiller of Brown University was on the show earlier, and she said Kevin McCarthy will remain Speaker of the House simply because the Democrats will back him if the Republicans won't, because at least it will be some sort of cohesive voice that is better than the alternative. Does that concern you, that Kevin McCarthy will remain Speaker, but perhaps only at the behest of Democrats who are concerned about the alternative?
I actually disagree with the analysis. I think Kevin McCarthy will remain Speaker with Republican votes. I actually don't even think you'll see a motion to vacate. We had a robust family conversation last night into the late hours of the evening talking about this legislation. And while it's true, there are some Republicans that would like to see a better bill. They think that they could get a perfect bill. At the end of the day, I think everybody in the room recognizes that this bill is a step in the right direction, and they're appreciative of the Republican negotiating team that moved the ball forward. You got to remember, we started with the president saying that he was going to refuse to negotiate. He put his head in the sand. He went to Delaware, went off to Japan rather than negotiating. And at the end of the day, we came back with $1.5 trillion in savings.
You sound like Paul Ryan on an off day. Come on, Congressman, come on. What I'm hearing in the zeitgeist right now from Anne Marie Horton is the Democrats are taking a victory lap because they pretty much got what they wanted. Moderate Republicans like you are saying, okay, let's get this done and move on. And you got a bunch of people trying to block this and shut down the government. I got to go back to the fact you lived Paul Ryan's decline as Speaker of the House. I want to go from Boehner to Ryan to McCarthy. What does a Speaker have to do now not to be Paul Ryan, not to be John Boehner?
I think actually the Republicans are quite unified in the House right now, and I think that shows when we passed the Limit, Save, Grow Act. Many people across the United States underestimated the ability of Republicans to come together and unify and pass a bill. In fact, President Biden didn't think we could do it either. That was part of his negotiating tactics. And at the end of the day, we came together. I think the Republican conference in the House is quite unified to address the spending challenges that we face.
But, you know, the speaker, okay, I'll go with that. But the answer is, John, the speakership here is under real threat, and it comes up suddenly. Did it come up suddenly, Congressman, for Paul Ryan? Was everything fine, and then, boom, you're his aide in office, and all of a sudden, boom, he's under threat by these Republicans?
I was working in the private sector for quite some time, so I wasn't on Capitol Hill for about 20 years before I ran for office. But I think what you see is at the end of the day that these things can rise on occasion. But if you talk to Republican members, we're unified in the House of Representatives. Okay. I think everyone recognizes that this is a good bill. There's just some conservative and Republican members that would like to have a better bill. That's not the bill that's on the table.
Congressman, I'm just a spectator and watching this play out for a long time, both within the United States and abroad as well. And every single time we get into this debacle, we just raise the debt ceiling again and again and again and again. Whether that's a Republican president or a Democratic president, it's the same outcome. We raise the debt ceiling. Brian, you heard JP Morgan's Jamie Dimon come in from the break there saying, I wish one day they'd get rid of the whole debt ceiling thing. Why do we still have it? And isn't it somewhat embarrassing for the president, whether Republican or Democrat, to go abroad to places like Japan, for the G7, to try and lead the global effort on a whole bunch of issues, to then be looking back and have this EM-type debacle playing out at home?
In a period of time of divided government, there's actually few opportunities to negotiate the spending reforms that are needed, in particular a period of time when executive authority has grown so dramatically. In this bill, we actually address the fact that the president tried to dramatically alter student loan payments. That never went through Congress in the first place. Unfortunately, based on executive overreach, what we have is so few opportunities to get spending under control, where the executives, both parties, are absolutely right, continue to spend money through executive action. And this negotiation allows us to actually bring the president to the table and have a conversation about how we're going to get spending under control. And I think, again, at the end of the day, this is overall a good bill moving us in the right direction.
Yeah, the one bill aside, Congressman, don't you see where this is going, though, that ultimately, and we're out of time, so if you want to continue this conversation, by all means, come back another time. It just feels like we're in the process now of deliberately manufacturing crises to do exactly what you just explained. And at some point, that's going to erode the confidence in this country and potentially the US debt market, too. So we've got to leave it there. Congressman, if you want to continue, happy to do that another time. Congressman Brian Steele there. Wisconsin, Tom. These are big issues, and they're not going away anytime soon. Let's be clear about that, no matter who wins the next election.
I'm trying to get a measure of Speaker McCarthy's risk as we move forward here. He had a good day yesterday.
Hornback and Morgan Stanley up in the next hour. Joe Carey Hall of Bank of America, Jean Balvin of BlackRock, all of that coming up in about 30 minutes.
Bloomberg surveillance, Lisa Abramowicz and Tom Keene, Mr. Ferro, in preparation for the next hour. In the next hour, Lisa, you may see, I'm getting it up here, West Texas Intermediate, are you going to see a 66 handle in the next hour? $67.12. $66 a barrel, Lisa. I mean, that's where you got to go long oil again. I mean, you know, a couple barrels in the living room.
How many people have come on the show and said, you know, it's just a technical trade. This isn't actually something driven by fundamentals and a lack of demand.
And tell that to Riyadh this morning.
But that's really the issue. And all of a sudden now you have the likes of Bob Michael and many others coming out and saying the declines that you've seen in the broader commodity sector is telling us something. It is screaming about a slowdown that is coming.
Yeah, Bob Michael featuring the Bloomberg Commodity Index, which is the old UBS index. Legit math, to say the least. Right now, before we get to Blarina Urici with T. Rowe Price, Michael McKee's going to give us a brief here without 8:30 data. And I got to go something, John, Michael, you lectured me on years ago, which is pay attention to jolts survey. Are we finally seeing the labor market crack?
Well, we hope so. We saw a decline in the number of job openings last month. When we say last month, it's 2 months ago. So this is somewhat old data, but we are expecting another decline this time. And that would be good news for the Fed, which is thinking that the high level of job openings is one reason that we're still seeing a lot of pay increases for workers, because it's hard to find them. But if it continues to go down, that should take a little pressure off. Still a long ways to go till we get to the pre-pandemic level of around 6-7 million.
We've been talking this morning about Loretta Mester's comments in the Financial Times about going raising rates one more time before pausing or taking a breather. Is that becoming more of a consensus now that there hasn't been a fuller shakeout in the smaller bank sector?
It does seem to be more of a consensus, although the voters, the Fed voters who have spoken, are about evenly divided. I think what you're going to see is Friday and then the CPI report, Friday's jobs, of course, and the CPI report on the 13th are going to be dispositive. So I wouldn't go to the bank with what's in the WIRP Fed Funds Futures argument that there's a 65% chance or so of a rate increase, because that could change depending on the data. But it does look like most people at the Fed leaning in that direction now.
Before we let you go, I do want to get your view on the debt ceiling debate, not necessarily the politics of it, but with respect to the economic ramifications. And one thing that we haven't talked about that much is the student loan repayments that have been flagged will have to start in a couple of months' time as a result of this deal. People are saying this will eat into disposable income, eat into disposable spending in a way that hasn't been accounted for in the economy. How much are you hearing that from economists?
Oh, you're hearing that a lot. It's probably the biggest thing in this debt ceiling package that would affect the economy, because the overall numbers are pretty small, but we could see a compressed period of declining domestic spending if people who are spending that average $369 a month payment on something else right now have to start sending it back to the government lenders. But it's also been pointed out that when they ended the supplemental food stamp program and when they ended the supplemental child care tax credit, we thought that would happen and the effects were much smaller. So it is certainly possible that it doesn't have a major impact on the economy right now. And of course, it'll be a little hard to tease out in terms of other things that have been going on, the Fed raising rates, et cetera. But it will be something to watch.
Michael McKee, thank you so much. The JOLTS survey out, I believe, in the 10 o'clock hour. Bluerina Urici joins us right now, U.S. economist T. Rowe Price, here on the shifting tides of the American economy. Just as a basic idea, do you have any handle on second quarter GDP yet? I mean, everybody's waiting on recession, but what's a T. Rowe Price call on where we are in growth right now?
So right now it feels like we're going to get another quarter of positive growth, at least the components that I take more signal from, which is consumer spending and personal consumption expenditure component. We have had a lot of volatility in the inventory data and net trade, but overall, when you look at consumer spending in the U.S. economy, that has been holding up. And actually, a lot of people expected this shift in spending from goods to services, but we actually are continuing to see in the economy that both components remain strong and the U.S. consumer goes out to spend.
One of our themes is a return to American exceptionalism. Country by country, they seem to be slowing down, widely anticipated by IMF and frankly by you. At T. Rowe Price, is America the place to be because of economic growth?
Well, I think we saw that last year, and I think that theme continues, that the Fed was able to increase interest rates faster and sooner here than other central banks because of the resilience of the economy. The U.S. consumer has been strong. I do think, however, that the direction of travel for the second half of the year is one where a ton of headwinds are gathering momentum. So the U.S. economy is going to slow as well, and we're already seeing signs that the labor market is starting to cool down. All those things, I think, are going to play out such that the U.S. will not be as strong in the second half of the year as it was in the first half.
Earlier this morning, Wells Fargo CEO Charlie Scharf was speaking at a conference, and he talked about credit card spending being up 10% so far this year. Debit card spending is about flat, but people are still out there spending in a significant way. He also went on to say that credit quality remains strong and that the demand and the use of some of these instruments is much stronger than expected at this point in the cycle. What are you looking at, Blarina, that points to something that is softer, that is perhaps an inflection point to a lower growth rate?
So I think a lot of what was happening last year was the labor market was adding jobs and aggregate hours and aggregate income was growing very fast, even faster than inflation. I know when you look at average hourly earnings, that was being surpassed by the rate of inflation, but the payroll proxy that I looked at was not. Now that payroll proxy has been declining because of the pace of job growth is down, but more importantly, hours worked are declining faster than employment growth. So I think this is important. It's an important factor to watch. The other one has been the excess savings story. Remember that we were talking a lot about it just as the pandemic ended, whether that was a wealth effect or it was going to be spent by consumers. Turned out last year that consumers continue to spend that excess savings buffer, and I think that's going to run out at the end of this year. And both of those, then you add the fiscal impulse, which is only slightly negative, but it's adding to this momentum that is dragging the economy down. All those factors make me less optimistic about the U.S. consumer later in the year.
Less optimistic isn't exactly the gloom and doom that we're hearing from some people. And I am wondering whether you think that the momentum that we currently have, based on all these indicators, is enough to avoid recession and makes a recession improbable just simply because there still is this savings. There still is this power to go out and spend.
It's certainly possible that we can get a soft landing, but I think historically with this combination of factors of high inflation, Fed tightening, liquidity draining, we haven't achieved it. So it would be an economic exceptional situation here if we do achieve a soft landing. How could we get that? I think what happens in the labor market is key. We'll get the jolts data, as you mentioned, later today. One scenario could be that we get the softening in the labor market that we need purely through a closing of vacancies, which is something that Governor Waller has been discussing since last summer. And I do think that what we've seen so far seems more consistent with a soft landing in the labor market.
Blarina, we're talking about lower yields. We heard this from Bob Michael of J.P. Morgan earlier. Price up, yield down, and there's a raging debate about this. You're in an interesting seat at T. Rowe Price, managing gazillions of dollars here. Is the overarching theme linking your economics with your portfolio managers, price up, yield down in bonds?
So I think lots of factors have been affecting yields in recent days, but zooming out, looking at the 2-year, for instance, from September to date, it's been in this range of 4 to 4.5, I think, for most of the time. What is this telling us? I think the markets, in a way, is buying the story that yields will be higher for longer, but probably we are quite close to the peak in interest rates. And so from here, I don't think there is that much upside for yields.
I mean, Lisa, I think this is just a profound idea, and that Bullard and others are talking about higher rate regimes we've got to get to here, and others. I mean, the calendar's moving forward. What Ed Hyman says, or Bob Michael says, or what we hear from Blarina is something in January or late last year. They're now saying we're going to compress this into 4 or 5 months. I find that extraordinary.
And how much does this have to do also with the China reopening? And Blarina, I do want to just end there really quickly to get your thoughts on how much suddenly the disinflationary push that people are talking about accelerating stems from a China, which the reopening really doesn't seem to be as powerful as many people expected it to be.
I think the China economic growth story looks very different than it did 10 years ago. I don't think they're going to drive economic growth through investment as they did. And I think this has repercussions for global inflation and global demand on commodities. And I think we're seeing that play out.
Blarina, thank you so much. Blarina Arucci with us with T. Rowe Price here on the American economy and the raging debate forward. Maybe a softer tone that we heard from Bob Michael. Are we lucky on this day of China data? I mean, we say we're lucky, but you know it's our team doing it. You and I are taking the surveillance nap, and the team is working 24/7. Bill Lee with us earlier with all of his IMF cred. And then having Leland Miller come up is just exceptionally fortunate today.
To understand the on-the-ground reality behind
Yeah.
the pretty disappointing PMIs that came out, how much is this just manufacturing not keeping up and services continuing to chug along? How much, and this is really the key question, you kept bringing it up, and I think it's a good one, is there really an inability or a complete reluctance by the Chinese government to offer up some stimulus in some capacity?
I'm in the camp here. They don't have a choice because of the mandate of the kind of regime, the kind of politics they are. They've got to keep people employed. Someday I'll be wrong on that, but they got to keep people employed.
From a global perspective, how much that bleeds out into the global economy, though, is as opaque as the reopening has been and as the entire pandemic economy. And this is one of the reasons that's sort of feeding into the uncertainty that you get with a lot of economic views.
And the economic views is, again, and I think of Ed Hyman way out front here on calling for a lower rate regime. Let's remind ourselves the 10-year yield, 3.67%. Where's it going to be Labor Day, Bob Michael? Where's it going to be end of the year, Ed Hyman? And on you go to price up and yield down as well. Coming up, the conversation of the day on China. We had William Lee with us of Milken earlier. Leland Miller of China Beige Book. Must listen, must watch for Global Wall Street. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Jamie Dimon says J.P. Morgan Chase will be in China in both good and bad times, remaining committed to doing business in the Communist Party-ruled nation. CEO of the biggest U.S. bank also says he doesn't foresee a decoupling between the West and China.
Over time, yeah, there'll be less trade. You know, it'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
Dimon's remarks come as China-U.S. relations are at their worst in decades. Photos obtained by Bloomberg show Elon Musk at a restaurant in Beijing. The Tesla CEO met with China's Minister for Industry and Information Technology. Now, Musk is expected to tour Tesla's Shanghai factory later today. South Korea's spy agency says North Korean leader Kim Jong-un may be suffering from a sleep disorder. The National Intelligence Service says North Korean authorities are intensely collecting overseas medical information for top-ranking officials with insomnia, including details on medications used to treat it. North Korea has also confirmed that an effort to launch a military spy satellite into orbit failed. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
When we do business in a country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China is obviously going to do what they think is good for itself.
Jamie Dimon in Shanghai with our Steve Engel. Great interview there on the optimism of banking forward on the Pacific Rim with the head of JP Morgan. A lot of conflicting trends today. Lisa, Neil Dutta, who has been very optimistic and correct on a non-recession America, looks at what Bob Michael said, and Michael says rates are coming down, inflation will come down, and what that means is the income we make will be more valuable. Inflation-adjusted incomes will expand. That's been a core optimistic foundation for Mr. Dudd of Renaissance Capital.
Yeah, return of the bond boom. And this is really the key question. I mean, we talked about Jean Bovin going over of BlackRock with John in the next hour. He takes the opposite view, saying that longer-term bond yields are not going to go down as much. And this really goes down to, do you believe that inflation is sticky or not? And that is one of the biggest debates right now, where there really is not a consensus.
If you're part of Global Wall Street, and particularly if you're part of everything that has to do with investing in America, here is your Chinese conversation of the day. William Lee was with us earlier with some real caution off of difficult Chinese data this morning. Leland Miller flat out disagrees. He is the co-founder, chief executive officer of a China Beige Book with prodigious data analytics of China. Leland, you're more optimistic. What is the data you see in China that leads you to Pacific Rim optimism?
Yeah, optimism is a strong word, but I think people have gotten too gloomy. And I say this because, there was an ebullience earlier in the year that there was going to be this explosive Chinese recovery. It was going to happen fast. It was going to happen a lot like America's. That was never in the cards. China had to get over COVID. So, January, February, even March was mostly taken off. So we're starting to see, April and May, whether there's going to be much of a recovery. Now, some of the latest data have been bad. Some of the stuff that we're seeing has been better than what the government's been putting out. So we're not seeing the worrying falls that have perpetuated this gloom. Stock market falling and economic data being weaker than expected has created a sense of gloom in markets, and we're just not there.
Dr. Lee talks about a dearth of innovation, which comes from a more strident autocracy in Beijing. No question about that. Given the changes that you see off the party Congress, is this a Chinese leadership that can still use traditional monetary and fiscal stimulus to goose the economy?
Well, the economic model still relies on that in part. They're just a lot more restrained and, constrained from being able to do it in the way they did before. So, yeah, I think that there are elements that, as things get worse, they're going to be under more pressure to stimulate. And look, I think the mistake right now is people think they're not stimulating. We've seen a lot of policy support already this year. We're seeing rates sliding. We're seeing loan rejections falling, which means the government has been more permissive in credit provision. So it's not nothing. It's just that they haven't resorted to the big infrastructure build out. They haven't been building in order to stimulate growth. I think they want to stay away from that, but they are being supportive on the monetary side. So policy support is there. It's just not what it was in the old days.
Leland, you said that people have been too gloomy on China. Where specifically are people underestimating how much strength there really is?
I think there's two places. The first is, everyone's shaking over this latest manufacturing PMI. When we look at our manufacturing data, we're not seeing gloom in terms of orders. Domestic orders are okay. Foreign orders are okay. They're weaker to the U.S. and Europe, but they're stronger to Asia. And then we look at this consumption recovery that everyone's been expecting but hasn't seen. We're starting to see elements of that. The problem before has been it's been uneven, and you've seen sort of travel and hospitality go up, and then they go down and something else goes up. We're seeing better data in May than we saw in April, which was better than March. So, we're seeing not the recovery that so many people unrealistically expected earlier this year, but we're seeing a recovery that's there and defies a lot of this total pessimism in markets over China's economy.
How much of that recovery is in domestic spending and not international spending? I'm basically an economy that is contained within China and doesn't necessarily percolate out in the same way that traditionally Chinese economic activity did.
Well, I think that's exactly the positive story, that most of this is coming from, domestic demand. You look at our inflation gauges, we're seeing strengthening prices. We're seeing strengthening jumps in all our inflation gauges across the board, which are showing more domestic demand. Our domestic orders are up. Look, it's a relatively weak international, global economic environment. Manufacturing in China has been going like gangbusters for years. So we're not expecting manufacturing to lead, but manufacturing is doing okay. And we are seeing retail and services do better each and every month. So as long as you calibrate your expectations, this is not the massive disappointment that everyone's making it out to be, at least yet. We need to see the data through June, and then we're going to be able to make a better call on this.
How does that affect your longer-term view of slowing growth? We were talking with Bill Lee of the Milken Institute, formerly of the IMF, and he was saying he sees potentially below 5% this year, but then going down to a 3% kind of level on an annual growth perspective. Do you kind of take the same kind of view?
Absolutely. I'm glad you pivoted to that because, look, this is a cyclical bounce back. You're seeing there's a lot of reasons why 2023 growth will be better than 2022. COVID zero's off. You've got a better base of comparison to work off of, but it doesn't change the long-term story. And the long-term story is of a significant structural slowdown. Right. So, we've been talking about these numbers, 2 to 3% for years and years and years, and they've been scoffed at. But now people are taking them seriously.
Leon, when we see the unemployment discussions, millennials 20%, whatever, take us away from the Pacific Rim. Take us away from a quarter of a mile away from the Mandarin Hotel in Hong Kong or whatever fancy place I'm going to stay. What is the people's reaction in China to unemployment?
Well, look, I think the major issue is that with slowing growth, you're going to need to be transitioning jobs from the traditional ones to new ones. And there doesn't seem to be a great long-term plan for doing so. So, the question is, what does the Chinese government care most about? You're exactly right. They care about jobs. They care about employment. They care about stability. Yeah. So they're going to have to be providing for this. You have to create an economic growth to be able to do this. If you're just battening down the hatches and saying focus on semis, it won't do it.
So at the margin, are they competing with Vietnam or a more prosperous Korea? I mean, on a labor economics basis, what's the shortest path to success for Beijing to create marginal jobs?
Well, they think they're competing with Korea and Japan. They're still competing a bit with Vietnam. The model is in transition right now. So the question is, are you able to make that transition without social strife hitting along the way? And look, this is a very dicey proposition. This is a very hard thing to do. So if you no longer have high levels of growth and you're no longer relying on property build-outs and infrastructure build-outs to drive growth, you're trying to transition to a sort of a higher level, economy. It's not at all clear they can do this without problems along the way. So this is why I think people are worried about China in the medium term and long term, and certainly we are.
Leland Miller, thank you so much. Just fabulous here. Great to have you on China Beige Books. Leland Miller, and of course that dovetail with William Lee of the Milken Institute makes for good China analysis. Today we say thank you to Stephen Engel in Hong Kong, his conversation in Shanghai with Jamie Dimon of J.P. Morgan. Lisa, I'm watching here, and it makes for good TV theater, and I've gone down in flames. I need a $66 print on West Texas Intermediate. I didn't get it. I got the 67.06. But I don't even know how to go OPEC plus here on this. I mean, I don't know what the supply microeconomics is for Riyadh here to boost the price.
You know who does know? ChatGPT.
Really?
There was an article that just came out.
Did we hire them?
Yeah, we did hire them. Evidently, hedge funds are increasingly hiring ChatGPT to handle all the grunt work, which I think is pretty much on brand. I mean, that's what I'm hearing from people who are in school.
Can I go mathy here?
Please.
For 30 seconds? Take the longest series I have, which is Saudi Light. It's a Arabian Saudi Light series back to the 1950s, pre-Nixon and all that. And I looked at the collapse of 1986 on a log chart, and you compare that move to now, and it equates out to $40 to $41 a barrel. So we're basically halfway there to a 1986 kind of feel and a plunge in oil. We're nowhere near that agony yet, but there it is.
Big question, how does Riyadh handle Russia? How does Riyadh handle Moscow, which is pumping a lot of oil, perhaps above the quotas and the agreed upon discussions?
We're going to let Will Kennedy and our world-class team on hydrocarbons discuss this. It's certainly a theme here into June. Tomorrow on the program, sell in May and go away. The Bramo Report. We'll have that for you completely. Stay with us through the day. This is Bloomberg Surveillance.